Hello there and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Where in the world are you watching from? A quiet bedroom as the evening deepens, a cozy corner where the weight of the day is finally lifting. Wherever you are, you're exactly where you need to be. Tonight we're going to explore something you probably have in your wallet right now. Something so ordinary you barely think about it. A small rectangle of plastic that represents one of the quietest revolutions in human history. We're going to discover how buy now, pay later became possible, how trust became portable, how a forgotten wallet at a New York restaurant somehow changed the way the entire world handles money. This isn't a story about credit card debt or financial anxiety. Instead, we'll move slowly and carefully through the decades, watching as commerce transformed from something deeply local and personal into something global and instant, all because of a simple idea that took 70 years to fully unfold. If you enjoy these calm explorations of how money quietly changed our lives, a like and subscribe really helps others find their way here too. And to those already subscribed, thank you for being part of this thoughtful community. So settle in, let your shoulders drop away from your ears, take a slow breath, in through your nose, out through your mouth, and let's begin our gentle drift through the history of credit cards. There's nowhere you need to be, no deadlines to meet, just listen and let the story unfold. If you drift away, that's perfectly fine, that's what we're here for. Let's begin in a world without credit cards, before 1950, when buying something required either cash in hand or a personal relationship with the person selling to you. Imagine for a moment what it meant to go shopping in 1890. Or 1900, or even 1940, you'd leave your house with a specific amount of money in your pocket or purse. Maybe you'd counted it before leaving, knowing exactly what you could afford. The weight of coins was real, physical. Silver dollars were heavy. A pocket full of change pulled at your coat. Paper money was less common then, more valuable, something you folded carefully and kept track of because losing it meant it was simply gone. When you walked into a store, a shop, a market, the transaction was immediate and tangible. You handed over money, you received goods. The exchange was complete right there in that moment with no yanshu. There was a simplicity to this, a clarity. You knew exactly what you had because you could feel it, count it, see it diminish as the day went on. But there was another kind of buying, one that didn't require cash in that exact moment. This was credit. But credit of a very different kind than what we know today. This was local credit, personal credit, credit that depended entirely on who you were and who knew you. Think about a small town in 1900. The grocer knew your family, he knew your father, knew where you lived, knew whether you were good for the money. At the end of the week or the end of the month you'd settle up. He kept a ledger, a physical book with your name written in it, and underneath your name, a list of what you'd purchased. Flour, sugar, coffee, cloth. The amounts written in careful handwriting. This wasn't a contract in any legal sense. It was trust, pure and simple. Trust built over years, over generations sometimes. This system worked beautifully as long as you stayed within your circle of trust. The grocer extended credit because he knew you. The tailor extended credit because your family had been customers for 20 years. The pharmacist, the hardware store owner, the feed and grain merchant, they all maintained their own ledgers, their own systems of knowing who could be trusted and who couldn't. But step outside that circle, travel to another town, another city, and you were nobody. Your reputation didn't travel with you. The grocer in the next county over had no idea whether you'd pay your debts. You were financially speaking invisible, so you needed cash. Travelers carried significant amounts of money, which made them targets for theft. The well-to-do solved this partially through letters of credit from their banks, formal documents that were cumbersome and slow, but at least allowed them to access funds in distant cities. For businesses, for department stores that were emerging in big cities in the late 1800s, this created a challenge. How do you serve customers who want to make large purchases but don't want to carry huge amounts of cash? How do you build customer loyalty when shopping is still mostly transactional? The answer, starting in the 1890s, was the charge plate. Picture a small metal plate, about the size of a military dog tag, embossed with a customer's name and account number. Department stores issued these to their regular customers, their trusted customers. When you made a purchase, the clerk would take your charge plate, place it in a machine along with a paper slip, and create an impression like a rubbing. The raised letters and numbers would transfer onto the paper. You'd sign the slip. At the end of the month, the store would send you a bill for everything you'd charged. This was revolutionary in its way, but notice the limitation. The charge plate worked only at that one store. Your Macy's charge plate meant nothing at Gimbel's. Your Marshall Field's plate was useless at Carson Pirie Scott. Credit was still bound to specific merchants, specific relationships. It hadn't yet become portable across different businesses. In the 1920s and 30s, oil companies began experimenting with courtesy cards. If you were a regular customer of a particular gasoline brand, they might issue you a card allowing you to charge fuel at any station carrying that brand. This was novel, this idea that credit could follow you geographically, as long as you stayed within one company's network of stations. A traveling salesman could use his courtesy card across multiple states, at any station displaying the right company sign. Western Union had metal cards for frequent customers. Some hotels issued credit tokens to regular guests. These were incremental steps, small experiments in making credit slightly more portable, slightly less personal and local. But they were all still closed systems. Your oil company card worked only for gasoline. Your hotel card worked only at hotels in that chain. You still needed cash for restaurants, for shopping, for most of daily life. The fundamental problem remained unsolved. Credit required either a personal relationship or limitation to a single merchant or brand. No one had figured out how to create credit that worked across multiple types of businesses, in multiple locations, without requiring the merchant to personally know and trust the customer. That problem seemed almost unsolvable because it required something that didn't yet exist. A way to transfer trust from a central authority to thousands of merchants simultaneously, and to do so for thousands of customers the merchants had never met. The world of 1945, as World War II ended and American prosperity began to accelerate, was still fundamentally a cash world. Yes, you could write checks if you had a bank account, but checks required the merchant to trust that you had money in your account, and clearing a check took days. Yes, you might have a charge account at your local department store, but that helped you only at that specific store. For everything else, for the great majority of transactions in American life, you needed cash. And cash meant planning, meant limits, meant the physical weight and risk of carrying money. People accepted this because they'd never known anything different. The idea that you could walk into a restaurant in a city you'd never visited before, order a meal and pay for it with something other than cash, something that represented a promise to pay later, backed by a bank you might not even do business with, accepted by a restaurant owner who'd never met you, this seemed like fantasy. The infrastructure didn't exist. The trust mechanisms didn't exist. The technology, even the concept, didn't fully exist, but it was coming, slowly, quietly, built from small innovations and incremental ideas. The world was about to change, though no one quite realized it yet. A businessman was about to forget his wallet, or perhaps that story would be invented later to make the innovation seem more dramatic than it really was, more sudden, when in fact it was the product of years of experimentation and evolution. Either way, the forgotten wallet, real or mythical, makes for a good place to begin the next part of our story. Let that image rest in your mind for a moment. A world where buying required either cash in hand or a known face. A world where trust was intensely local, deeply personal, limited by geography and relationship. That was the world about to be transformed, slowly and quietly, into something we now take entirely for granted. The story people love to tell about the birth of the credit card begins with embarrassment. It's February 1949, a cold evening in Manhattan, and a businessman named Frank McNamara is having dinner with colleagues at Major's Cabin Grill, a well-regarded restaurant in Midtown. The meal is pleasant, the conversation good, and when the check arrives, McNamara reaches for his wallet, only to discover with a sinking feeling that he's left it at home. He doesn't have enough cash to pay the bill. This is mortifying, the kind of social embarrassment that burns. His wife has to be called, has to bring money to the restaurant to rescue him. He pays the bill, thanks the staff apologetically and leaves, but the incident sticks with him. Later, telling the story to his attorney and friend Ralph Schneider, he articulates an idea. What if there were a card you could use to charge meals at restaurants, settling the bill later? Not a card specific to one restaurant, but something that worked at many restaurants, freeing you from having to carry cash or worry about situations like the one he'd just experienced. This story, The Forgotten Wallet at Major's Cabin Grill, has become legendary. It's tidy, dramatic, the kind of origin myth that makes sense. Great innovations spring from personal frustration, from problems demanding solutions. But like many origin stories, it's probably too neat, too convenient. Some historians doubt whether it happened exactly that way, or whether it was embellished later for marketing purposes to give the credit card a memorable birth narrative. What we know for certain is that McNamara and Schneider, along with McNamara's friend Casey Taylor, founded Diners Club in 1950. The concept was straightforward. Diners Club would sign up restaurants willing to accept their card. They'd sign up members willing to pay an annual fee for the privilege of using the card. When a member charged a meal, the restaurant would send the bill to Diners Club, which would pay the restaurant minus a commission, currently 7%. At the end of each month, Diners Club would bill the member for all their charges, and the member would pay in full. Notice what this was and what it wasn't. It wasn't a loan, not in the traditional sense. Members were expected to pay their bills in full every month. There was no option to carry a balance, no interest charges. It was a charge card, not a credit card in the modern sense. The value proposition was pure convenience. You didn't have to carry cash. You didn't have to worry about having enough money for an expensive meal. You'd settle up later, once a month, in a single payment. The first Diners Club cards were issued in February 1950. They were made of cardboard, of all things, with the member's name printed on them. About 200 people received cards initially, mostly friends and associates of McNamara and Schneider, people willing to try this experiment. The card was accepted at 14 restaurants in New York City, establishments that McNamara had personally convinced to participate. Think about what was being asked of these restaurants. They had to trust that Diners Club would actually pay them, minus the 7% fee. They had to train their staff to recognize and accept these cardboard rectangles. They had to change their accounting systems to handle charges that wouldn't be paid immediately in cash. And they had to give up 7% of the bill, a significant amount for the privilege of participating in this unproven system. Why would they agree? Partly because McNamara was persuasive, partly because the restaurants he approached were high-end establishments where the clientele already expected to be able to charge meals to accounts. But mostly because McNamara convinced them that the card would bring them more customers, that Diners Club members would choose restaurants that accepted the card over those that didn't. The 7% fee, he argued, was worth paying for the additional business. For members, the value was even clearer. For an annual fee of $3, you gained the convenience of not carrying cash and the social cachet of using this exclusive new card. Only certain people had Diners Club cards. It marked you as someone who dined out frequently, someone who travelled, someone who was, in the language of the time, a cosmopolitan. The card had status value beyond its practical function. In its first year, Diners Club signed up about 20,000 members and 1,000 restaurants. These numbers sound small now, but in 1950 they represented remarkable growth. The idea was spreading, not virally in the modern sense, but steadily. Through word of mouth and targeted marketing, Diners Club focused on businessmen who travelled, who entertained clients, who needed to charge meals in cities away from home. The card solved a real problem for this demographic, but it remained limited. The card worked only at restaurants and eventually at some hotels. You couldn't use it to buy clothing or groceries or gasoline. It was a dining and entertainment card, useful within that sphere but not beyond it, and it required paying in full every month, which meant it was really only suitable for people with steady, substantial incomes. Still, Diners Club had proven something crucial. They demonstrated that a three-party credit system could work. The three parties were the cardholder, the merchant, and the card company sitting in the middle, facilitating the transaction and taking a small cut. This was different from the old two-party systems, where credit existed only between customer and merchant directly. By inserting themselves as the third party, Diners Club made credit portable. Restaurants didn't need to know you personally or keep track of your charges. They just needed to accept the card and trust Diners Club to pay them. Other companies noticed. In 1958, American Express, already well known for its travelers' checks, launched its own charge card. American Express had built a reputation over decades for financial reliability and global reach. When they entered the charge card market, they brought instant credibility and an established international network. Their card was also made of cardboard initially, then later plastic, and it worked on the same principle: charge purchases, pay in full monthly, no interest because there was no extended borrowing. American Express positioned itself as even more exclusive than Diners Club. Their annual fee was higher, initially $6. The card was marketed as prestigious, something for successful professionals and affluent travelers. The advertising emphasized status, sophistication, worldwide acceptance. If you carried an American Express card, you were someone who mattered, someone who moved in elevated circles. The charge card market in the 1950s was competitive but genteel. These weren't products for the masses, they were products for the business class, the professional class, people who needed to charge meals and hotel stays while traveling. The cards were useful, convenient, but they hadn't yet transformed daily commerce for ordinary people. What was missing, what neither Diners Club nor American Express had created, was true consumer credit, the ability to borrow money for purchases and pay it back over time with interest. The charge cards required full payment monthly. They facilitated transactions but didn't extend loans. For that innovation, for the transformation of the charge card into the credit card as we understand it today, we need to travel across the country to California, to a medium-sized agricultural city called Fresno, where a bank was about to conduct an experiment that would change everything. The idea seemed simple enough on paper. Bank of America, California's largest bank, would issue credit cards to people in Fresno. Unlike Diners Club or American Express, these cards wouldn't require full payment each month. Customers could carry balances, paying interest on what they owed. This was revolving credit, the same principle as a personal loan but attached to a card that could be used at multiple merchants. Joseph Williams, a Bank of America executive, championed the program. He'd studied charge cards and seen their limitations. He believed that what people really wanted wasn't just payment convenience but actual access to credit. The ability to buy things they couldn't quite afford right now, and pay for them gradually over time. This was a fundamentally different proposition. It transformed the card from a payment mechanism into a borrowing tool. Why Fresno? The choice was deliberate. Fresno was large enough to be a real test, with a population of about 150,000, and a diverse economy including agriculture, retail, and small manufacturing. But it was also geographically contained. A single, metropolitan area where Bank of America could control the experiment. If things went wrong, the damage would be limited to one city. If things went right, they could expand to other markets with proven success. On September 18, 1958, Bank of America mailed 60,000 credit cards to residents of Fresno. 60,000 cards sent unsolicited to people who hadn't applied for them, who might not even want them. This mass mailing, later called the Fresno Drop, was audacious, bordering on reckless. The bank was essentially saying, here's credit, whether you asked for it or not, whether you need it or not. Use it if you want. Imagine receiving a credit card in the mail that you hadn't requested. The letter explained what it was, how to use it, that you could charge purchases at participating merchants and pay later, either in full or over time with interest. Some people were intrigued. Some were confused, some were offended at the presumption, and some immediately saw opportunity, not always honest opportunity. The initial chaos was considerable. Many recipients didn't understand how the cards worked. They thought they'd been given free money and spent accordingly. Merchants were equally confused. Bank of America had signed up merchants before the drop, explaining the system, but training was minimal. Clerks didn't know how to process card transactions properly. Some merchants charged purchases without verifying signatures or checking the card against lists of cancelled accounts. Fraud was immediate and significant. People used cards that weren't theirs. Stolen cards circulated. Some individuals applied for cards using false information and then disappeared after running up charges. The bank's systems for tracking fraud were primitive, basically non-existent initially. They were learning in real time how many ways a credit system could be abused. For the first 2 years, BankAmericard, as the program was called, lost money steadily. The losses weren't catastrophic, but they were real. The bank had anticipated some fraud and some defaults, but the actual numbers exceeded projections. There were serious discussions inside Bank of America about whether to kill the program, to admit the experiment had failed and cut losses. But Joseph Williams argued for patience. The problems, he insisted, were solvable. Better merchant training would reduce processing errors. Better fraud detection systems would catch misuse. Better credit screening for new applicants when they eventually stopped the mass mailings and moved to application-based credit would reduce defaults. The fundamental idea was sound. It just needed refinement. Gradually, slowly, the system stabilized. Bank of America improved its processes. Merchants learned how to handle card transactions. Consumers began to understand how revolving credit worked, that carrying a balance meant paying interest, currently 18% annually. A rate that seemed high but was actually typical for consumer loans at that time. By 1960, BankAmericard was profitable in Fresno. The bank began expanding to other California cities, carefully this time, having learned from the Fresno chaos. They still mailed unsolicited cards but with better fraud controls. They trained merchants more thoroughly. They developed systems for tracking transactions and identifying suspicious patterns. By 1966, BankAmericard was available throughout California, with hundreds of thousands of cardholders and thousands of participating merchants. What Bank of America had created was genuinely new. Revolving credit attached to a card that worked at multiple merchants across multiple categories: restaurants, stores, gas stations, hotels. This wasn't a charge card requiring full monthly payment. This was actual consumer credit, borrowing that could extend over months or years, giving people access to purchasing power beyond their immediate cash resources. The interest charges were crucial to the business model. Unlike Diners Club or American Express, which made money primarily from annual fees and merchant commissions, Bank of America made significant revenue from interest on carried balances. This meant they could keep annual fees low or eliminate them entirely for some cardholders. The card became accessible to a broader demographic, not just the affluent business traveller, but the middle-class household wanting to finance a major purchase or smooth out a regular income. Of course, this also meant that people could accumulate debt, could borrow more than they could comfortably repay, could pay substantial interest charges over time. The card was a tool, and like any tool, it could be used well or poorly. Bank of America's innovation had given people more financial flexibility, more choice, more access to credit. But it had also given them more ways to get into financial trouble. The bank understood this, at least in principle. They set credit limits for each cardholder, amounts that varied based on income and credit history. The limits were meant to prevent people from borrowing beyond their capacity to repay. But the limits were often generous, sometimes too generous, and they could be increased over time, sometimes with minimal scrutiny. By the late 1960s, BankAmericard's success in California attracted attention from banks nationwide. Other banks wanted to issue BankAmericards in their regions to offer their customers this new form of credit. Bank of America began licensing the BankAmericard name and system to other banks, creating a network. A cardholder in California could use their card in New York at a merchant who accepted BankAmericard, even though the card was issued by Bank of America and the merchant's bank was entirely different. The transaction would be processed through the network, with funds eventually moving from the cardholder's bank to the merchant's bank, minus the various fees. This network model would become crucial, would ultimately transform BankAmericard into Visa, but we're getting ahead of ourselves. For now, in the early 1960s, the important thing was that Bank of America had proven revolving credit cards could work at scale, could be profitable, could serve millions of customers and merchants. They'd created the template that would dominate consumer finance for the next 6 decades and counting. The forgotten wallet at Major's Cabin Grill, whether it really happened or was invented afterward, had led to Diners Club. Diners Club had proven three-party payment systems could work. Bank of America had taken that proof and transformed it into something bigger, something that offered not just payment convenience but actual credit, actual borrowing, actual financial flexibility for ordinary people. The revolution was underway, quiet and steady, spreading city by city, bank by bank, card by card, transforming how Americans bought things and, in ways no one fully anticipated, how they thought about money itself. The success of BankAmericard in California through the early and middle 1960s created something interesting, something that happens often in business and finance. Success attracts imitators. If one bank could make money issuing credit cards, Why couldn't others? If BankAmericard worked in California, why wouldn't a similar card work in New York, in Chicago, in Atlanta, in every major city across America? And so began what historians of the credit card industry sometimes call the Great Proliferation, though that phrase makes it sound more organized than it actually was. What happened in the late 1960s was closer to a chaotic rush. Banks large and small launching credit card programs with varying degrees of preparation, flooding American mailboxes with millions of unsolicited cards, competing desperately for customers and merchants in a market that was still figuring out its basic rules and structures. Let's slow down and think about what was happening here, because it reveals something important about how financial innovation spread, how they move from novel experiment to ubiquitous tool, and what can go wrong during that transition. In 1966, a group of California banks that weren't Bank of America decided they needed their own credit card network to compete. They formed an association, initially called the Interbank Card Association, and created a card called Mastercard. The name was meant to suggest both mastery and the act of charging purchases, a bit of clever marketing that positioned the card as sophisticated and capable. Mastercard used a different logo than BankAmericard, two overlapping circles, red and yellow, that would eventually become recognizable worldwide. Meanwhile, in the East, banks in New York and other major cities were watching California's credit card boom with a mixture of envy and determination. They wanted in on this business, wanted to offer their customers the same convenience and flexibility that California banks were providing. Some banks licensed the BankAmericard name and system from Bank of America, others joined the Mastercard network, and some, particularly larger banks that thought they could go it alone, created their own proprietary cards. The result was explosion. By 1968, there were hundreds of different credit card programs across America. Some were local, some were regional, some aspired to national reach. Every bank seemed to be issuing cards, and the primary way they acquired customers was through unsolicited mass mailings. Picture your mailbox in 1968, 1969. You might receive multiple credit cards in a single week, cards you hadn't requested. From banks you might barely have heard of. Each card came with materials explaining how to use it, what the credit limit was, what the interest rate would be if you carried a balance. Some cards had annual fees, some didn't. Some had grace periods where you could pay without interest. Some charged interest from the moment of purchase. The terms varied wildly because there were no real standards, no regulations requiring consistency or clarity. For consumers, this was simultaneously liberating and overwhelming. Liberating because suddenly you had access to credit, multiple sources of credit, more purchasing power than you'd ever had before. Overwhelming because the sheer volume of offers was confusing, the terms were often unclear, and it wasn't always obvious which cards were legitimate and which were from questionable institutions. The banks were taking enormous risks. When you mail someone a credit card they didn't ask for, you're essentially offering them money without knowing much about their ability or willingness to repay. The banks did have some information. They typically mailed cards to people with bank accounts, people with addresses in desirable neighborhoods, people whose names appeared on lists suggesting financial stability. But this screening was crude, far from the sophisticated credit scoring that would develop later. Fraud became a serious problem almost immediately. When millions of cards are flowing through the mail system, many of them will be stolen. Postal workers with dishonest inclinations pocketed cards. Thieves stole mail from residential mailboxes. Cards were intercepted in apartment buildings. And once someone had a credit card that wasn't theirs, in an era before photo IDs on cards, before instant electronic verification systems, they could often use it freely for days or weeks before anyone noticed. There were also more sophisticated fraud schemes. People figured out that they could apply for cards using false information or stolen identities. They'd use the cards to make purchases, then disappear, leaving the bank with losses. Some individuals accumulated dozens of cards and ran up charges with no intention of ever paying, a practice that became known as bust-out fraud. The bank's losses mounted. In 1969, industry estimates suggested that fraud and credit losses were costing card issuers hundreds of millions of dollars annually. Some smaller banks that had rushed into the credit card business without adequate preparation were bleeding money, losing far more than they'd anticipated. Consumer debt was rising rapidly too. Americans were discovering that credit cards made it easy, perhaps too easy, to spend beyond their means. The psychological research on this would come later, but the basic phenomenon was already visible. When you pay with cash, you feel the loss immediately. The physical act of handing over money creates a kind of pain, what behavioral economists would later call the pain of paying. But when you pay with a credit card, especially in an era before real-time account tracking, the payment feels abstract, delayed, less real. You swipe or sign, and the pain of paying is postponed until the bill arrives weeks later. This led to spending that people sometimes regretted. The credit card bills at the end of the month could be shockingly high, adding up purchases made impulsively throughout the previous weeks. And if you couldn't pay in full, you'd carry a balance, paying interest, typically 18 to 21% annually, rates that could make debts grow quickly if you only made minimum payments. Stories began appearing in newspapers about people drowning in credit card debt, about families that had accumulated obligations they couldn't repay, about the dark side of this convenient new form of credit. These stories weren't sensationalized in the way media might handle them today, but they reflected genuine concern about whether this credit card proliferation was entirely healthy for American society. Consumer advocates began calling for regulation. If banks were going to offer credit to millions of people, shouldn't there be rules about how that credit was presented and managed? Shouldn't consumers have protections against fraud, against unfair billing practices, against unclear or misleading terms? Congress listened. In 1968, they passed the Truth in Lending Act, the first major federal legislation addressing credit cards. The law didn't limit how banks could issue cards or what they could charge, but it required disclosure. Credit card issuers had to clearly state their terms, the interest rate, expressed as an annual percentage rate that consumers could compare across cards, the grace period, if any, the method for calculating finance charges, the fees. The idea was that informed consumers could make better decisions, could understand what they were agreeing to when they used a credit card. This was a relatively gentle regulatory approach, consistent with American preference for market solutions over heavy-handed government control. The law didn't tell banks what rates to charge or whom to lend to. It just said, be clear about your terms, don't hide them in fine print, give consumers the information they need to make informed choices. But the Truth in Lending Act didn't address what many people saw as the core problem, unsolicited credit cards flooding through the mail. The practice created fraud opportunities and pushed credit on people who might not want it or manage it well. In 1970, Congress acted again, amending the Truth in Lending Act to prohibit the mailing of unsolicited credit cards. This was significant. After 1970, banks could no longer just mail you a credit card hoping you'd use it. You had to apply. You had to affirmatively request credit. The bank then had to evaluate your application, check your credit history, decide whether to approve you, and at what credit limit. This shifted the dynamic. Instead of banks pushing credit onto consumers, consumers would pull credit by applying for it. The 1970 amendments also established important consumer protections for lost or stolen cards. If your card was lost or stolen and someone used it fraudulently, your liability was limited to $50 maximum, and even that only if you didn't report the loss before unauthorized charges occurred. This protection was crucial for consumer confidence. People had been legitimately worried about what would happen if they lost their wallet. Would they be responsible for thousands of dollars in fraudulent charges? The $50 limit answered that question clearly. No, the bank would absorb fraud losses beyond that minimal amount. Think about what this meant for the banks. They were taking on significant fraud risk. Every stolen card, every compromised account cost them money. This created strong incentives to develop better security measures, better fraud detection systems, better ways to verify that the person using a card was actually authorized to use it. Through the early 1970s, the credit card industry matured and consolidated. The free-for-all of the late 60s, with hundreds of competing card programs, couldn't sustain itself. Many smaller programs failed or were absorbed into larger networks. The industry was gravitating toward what economists call network effects, where the value of a payment system increases with the number of people using it. If you're a merchant, which card do you want to accept? The one that the most customers carry. If you're a consumer, which card do you want? The one that the most merchants accept. This creates a powerful dynamic favoring larger networks over smaller ones. A card that's accepted everywhere is more valuable than a card accepted only at some stores. A payment network that processes millions of transactions has more data, better fraud detection, more resources to invest in technology and security. By the mid-1970s, the American credit card landscape was consolidating around two major networks, BankAmericard, which would soon rename itself Visa, and Mastercard, which would become Mastercard. There were other players, notably American Express and Diners Club with their charge cards, and Discover would launch in the 1980s, but Visa and Mastercard were emerging as the dominant forces in revolving credit cards. This consolidation wasn't mandated by government or planned by any central authority. It emerged organically from the logic of network economics and competitive dynamics. Banks realized they couldn't all maintain separate card systems. Cooperation on infrastructure, on network standards, on processing systems made more sense than endless fragmentation. But banks still competed fiercely for customers, offering different interest rates, different fees, different rewards and benefits, all while operating on shared network infrastructure. The regulatory framework established in the late 60s and early 70s created guardrails without stifling innovation. Banks had to be transparent about terms. They couldn't mail unsolicited cards. Consumers had fraud protection. But within these rules, banks had freedom to compete, to experiment with different business models, to find ways to serve different customer segments. One important development was the emergence of credit bureaus as centralized sources of credit information. Before credit bureaus, when you applied for a bank loan or a credit card, the bank had to rely on your statements about your income and debts, perhaps checking with a few references. There was no easy way to know your full credit history, what other debts you had, whether you'd defaulted on obligations elsewhere. Credit bureaus changed this. Companies like Equifax, Experian, and TransUnion collected information about consumer borrowing and repayment. When you applied for credit, the lender could check your credit bureau file and see your history. How many other credit cards did you have? Were you making payments on time? Had you ever defaulted on a loan? This information allowed lenders to make better decisions about whom to lend to and how much credit to extend. For consumers, this was a mixed blessing. On one hand, if you had a good credit history, it made getting credit easier. Your responsible behavior was documented and rewarded. On the other hand, mistakes followed you. A missed payment, a defaulted account. These would appear on your credit report and could haunt you for years, making it harder and more expensive to borrow. The credit bureau system also raised privacy concerns that persist to this day. These private companies were collecting detailed financial information about millions of people. Who had access to this information? How was it protected? What if the information was wrong? The Fair Credit Reporting Act, passed in 1970, gave consumers some rights to see their credit reports, to dispute inaccurate information, to have errors corrected. But tensions around credit bureau data collection and use would continue to simmer. By 1975, the credit card had evolved from experimental novelty to established part of American financial life. Roughly 50 million Americans had at least one credit card, though this was still less than half of adult households. The median credit card balance for those who carried balances was several $100s. Significant but not overwhelming for most middle-class families. The infrastructure supporting credit cards was becoming more sophisticated. Banks were investing in computer systems to track accounts and process transactions. The technology was primitive by modern standards, massive mainframe computers with far less processing power than a contemporary smartphone. But it represented cutting-edge data processing for its time. Merchants were adapting too. The mechanical imprinters, those zip-zap machines that created carbon copy impressions of embossed cards, were standard equipment at retail counters. Sales clerks learned to check signature panels, to call for authorization on large purchases, to watch for signs of fraud or stolen cards. The ritual of presenting a credit card, having it processed, signing a slip, these actions were becoming normalized, familiar, part of the ordinary texture of American commercial life. The credit card had also begun to shape consumer behavior in subtle ways. People were more willing to make impulse purchases. Why wait and save when you could buy now and pay later? This wasn't necessarily irresponsible. Many people used credit cards for convenience and paid their balances in full each month, avoiding interest charges entirely. But for a significant minority, credit cards facilitated spending beyond their means, accumulation of debt that would take months or years to pay down. Retailers discovered that customers spent more when paying with credit cards than with cash. This wasn't just anecdotal observation, but measurable reality. The average transaction size was higher for credit card purchases. Customers were less price sensitive, more willing to accept upgrades or additional items when the pain of payment was deferred. This made credit cards attractive to merchants despite the fees they had to pay to card companies. The fees, typically 2 to 3% of the transaction amount, were significant. For a merchant operating on thin profit margins, giving up 2 or 3% to card companies meant the difference between profit and loss on some sales. But merchants felt they couldn't refuse credit cards without losing customers to competitors who did accept them. This tension between wanting to avoid fees and needing to offer payment options customers demanded would persist throughout the credit card era. As we moved toward the late 1970s and into the 1980s, the credit card was poised for explosive growth. The regulatory framework was established. The network infrastructure was being built. Consumer acceptance was growing. The technological capabilities were improving. All the pieces were in place for credit cards to evolve from a product for the middle and upper classes into something approaching universality, a financial tool that nearly every American adult would eventually carry. But that growth would bring new challenges, new questions, new consequences, both intended and unintended. The credit card, this small piece of plastic that had emerged from a forgotten wallet or perhaps from careful business planning, was about to reshape not just how Americans paid for things, but how they thought about money, about debt, about consumption itself. The transformation was underway, quiet and steady, card by card, transaction by transaction, building toward a world where buying now and paying later would become so normal, so expected, that most people would never pause to consider how strange and revolutionary it actually was. The story of how credit cards spread across America, how they moved from regional experiment to national ubiquity, is really the story of two competing visions for how to organize a payment network. And at the center of one of those visions was a man named Hock, whose ideas about organizational structure were as revolutionary in their way as the credit card itself. By the early 1970s, BankAmericard had a problem. The card had grown beyond Bank of America's ability to manage it coherently. Hundreds of banks across the country were now licensed to issue BankAmericards, each operating somewhat independently, each with its own systems and procedures. When a customer used a BankAmericard issued by a bank in Ohio at a merchant in Florida, whose account was with a completely different bank, the transaction had to somehow be authorized, processed, and settled. Money had to flow from the Ohio bank to the Florida bank accurately and reliably, even though these banks might have no direct relationship with each other. This created coordination challenges that were becoming unmanageable. Different banks had different authorization procedures, different fraud controls, different billing cycles. The technology for processing transactions varied wildly. Some banks had invested in modern computer systems. Others were still using manual or semi-manual processes. There was no real standardization. No unified network in the technical sense, just a loose collection of banks all using the BankAmericard name. Bank of America recognized they needed to reorganize to create some kind of structure that could coordinate all these independent banks while respecting their autonomy. Banks are competitive institutions, jealous of their independence, unlikely to submit to any central authority that might tell them how to run their business. Yet they also needed to cooperate on network infrastructure, on technical standards, on the rules governing how BankAmericard transactions would be processed. This was where Hock entered the picture. Hock was an executive at a Seattle bank that issued BankAmericards, and he'd been thinking deeply about organizational theory, about how to create structures that could enable cooperation among competitors. In 1968, he was invited to join a committee tasked with solving BankAmericard's organizational problems. Hock's solution was radical for its time. He proposed creating a new organization, owned collectively by all the banks that issued BankAmericards, that would set standards and operate network infrastructure, but would not dictate how individual banks ran their credit card businesses. Each bank would have a vote in proportion to its transaction volume, ensuring that larger banks had more influence but preventing any single bank from dominating. Decisions would be made democratically. with banks cooperating on matters of common interest while competing fiercely for customers. In 1970, this organization was formed and named National BankAmericard Incorporated, or NBI. D. Hock became its first CEO. His title was modest, but his influence was enormous. He was building something genuinely new, what he called a chaotic organization, combining characteristics of chaos and order, centralized enough to coordinate but decentralized enough to allow innovation and competition. The governance structure Hock created was complex, deliberately so. There were multiple boards representing different stakeholder groups, issuing banks, merchant banks, regional associations. Voting rights were carefully balanced. The bylaws were thick with checks and balances, mechanisms to prevent any faction from seizing control. To outsiders, it looked unnecessarily complicated. To Hock, it was essential. Only through this careful balance could you get competitive banks to cooperate on building shared infrastructure, and the infrastructure needed building desperately. In the early 1970s, authorizing a credit card transaction was often a cumbersome process. For small purchases, merchants might not bother to get authorization at all, just checking the card against a printed list of cancelled accounts and accepting the fraud risk. For larger purchases, they'd call a phone number, reach an operator, read off the card number and purchase amount, and wait while the operator checked records and gave approval or denial. This could take several minutes, creating lines at checkout counters, frustrating customers and merchants alike. Hock and his team at NBI set out to create electronic authorization systems that could approve or decline transactions in seconds. The technology for this existed, at least in theory. Computers could store account information, check credit limits, flag suspicious patterns. The challenge was coordinating across hundreds of banks, each with its own computer systems, to create a unified network that could handle authorization requests from anywhere in the country and route them to the correct bank for approval. The system they built, called Base 1, launched in 1973. It was primitive by later standards but revolutionary for its time. When a merchant swiped a BankAmericard, the transaction information was transmitted electronically through telephone lines to a central computer system that would route the authorization request to the bank that issued the card. That bank's computer would check the account status and respond with approval or decline, all within seconds. The merchant got an immediate answer. The customer waited only moments. The friction in the transaction process dropped dramatically. Base 1 didn't cover all merchants or all transactions initially. The equipment required, the point-of-sale terminals that could read cards and communicate with the network, was expensive. Smaller merchants couldn't afford it. But larger retailers, department stores, hotel chains, these businesses invested in the technology because it reduced fraud, sped up checkout, and improved the customer experience. As the technical infrastructure improved, as authorization systems became faster and more reliable, as more merchants installed electronic terminals, the volume of BankAmericard transactions grew rapidly. In 1970, there were perhaps 100 million BankAmericard transactions annually. By 1975, that number had tripled. The network was creating value simply by existing, by making credit card payments easier and more secure. But there was still the name issue. BankAmericard suggested American Bank, which was fine in the United States but confusing or off-putting in international markets. NBI was expanding globally, licensing banks in Europe, Asia, Latin America. They needed a name that worked in any language, that didn't carry specific national or institutional associations. After extensive research, consulting with linguists and marketing experts, testing names in focus groups across multiple countries, NBI settled on Visa. The name was short, easy to pronounce in virtually any language, and carried associations with visas for international travel, with permission to go places with global access. In 1976, BankAmericard officially became Visa. The cards themselves were redesigned with the new logo, blue and gold stripes forming a V. The name change was more than cosmetic. It represented a fundamental shift in how the network understood itself. Visa wasn't a bank. It wasn't owned by any single institution. It was a cooperative network owned by thousands of banks, existing to facilitate transactions, to maintain standards, to build infrastructure that all member banks could use. Individual banks would compete for customers, offering different interest rates and terms and benefits, but they'd all operate on the same network, accepting each other's cards, processing each other's transactions. While Visa was organizing itself through the early and mid-1970s, it had competition. The Interbank Card Association, which operated the Mastercard card, was going through a similar evolution. Mastercard had started in the mid-1960s as a coalition of California banks that weren't Bank of America, and it had grown to include banks across the country, all cooperating to create an alternative to BankAmericard. Mastercard faced the same challenges BankAmericard did: how to coordinate hundreds of independent banks, how to build technical infrastructure, how to create standards and processes that would work nationally and eventually internationally. They solved these challenges in similar ways, creating a member-owned cooperative organization, investing in electronic authorization systems, expanding merchant acceptance. In 1979, Mastercard rebranded itself as Mastercard, again seeking a name that would work globally. The new logo, two overlapping circles in red and orange, was designed to suggest cooperation, partnership, the coming together of banks and merchants and cardholders in a network of mutual benefit. By the late 1970s, the American credit card landscape had essentially consolidated around two major networks, Visa and Mastercard. There were other players. American Express and Diners Club continued to operate as charge cards with their own closed networks, not bank networks, but single companies issuing cards directly. Discover would launch in 1986 as a third bank network, trying to compete with Visa and Mastercard. But Visa and Mastercard had such dominant market share, such extensive merchant acceptance, such name recognition, that competing with them was extraordinarily difficult. The relationship between Visa and Mastercard was peculiar. They competed intensely for transaction volume, for prestige, for the affiliation of the largest banks. Their advertising highlighted differences, real or exaggerated, in acceptance, in service, in brand image, yet they also cooperated in crucial ways. They both advocated for legislation favourable to the credit card industry. They both invested in similar technologies. They both maintained interchange fee structures that, while not identical, were similar enough to avoid price competition that might have benefited merchants or consumers. Some economists and regulators looked at this situation and worried about monopoly or oligopoly, about whether two networks dominating the market constituted healthy competition. The networks argued that they competed vigorously, that banks could and did issue cards on both networks, that merchants could choose which cards to accept, that consumers had choices. The debate would continue for decades, periodically erupting into antitrust investigations and lawsuits, never quite resolving. One interesting feature of both networks was that many large banks issued cards on both Visa and Mastercard. A bank might offer a Visa card to some customers and a Mastercard to others, or even offer both to the same customer. This seems strange from a competitive standpoint. If Visa and Mastercard are competitors, why would a bank support both? The answer lies in understanding what the banks were actually competing over. From the bank's perspective, Visa and Mastercard weren't really competitors. They were both just infrastructure, different payment rails that served essentially the same function. The bank's real competition was with other banks for customers. If a customer wanted a Visa, the bank would issue a Visa. If the customer wanted a Mastercard, they'd issue a Mastercard. Either way, the bank earned the same revenues from interest and fees. This dual issuing meant that Visa and Mastercard had somewhat muted incentives to compete on certain dimensions. If a merchant accepted both cards, which most did, then from the consumer's perspective the cards were nearly identical in functionality. The networks competed more on brand image, on prestige, on which card you wanted to carry for status reasons, than on actual performance or acceptance differences. Through the late 1970s and into the 1980s, both networks invested heavily in technology. The magnetic stripe, standardized in the early 1970s, became universal on cards by the late 70s. This stripe stored information electronically, allowing cards to be read by machines rather than requiring manual imprinting. The technology seems ancient now, but it was cutting edge then, enabling automation that reduced costs and improved accuracy. Electronic data capture systems became more sophisticated. Instead of merchants collecting paper charge slips all day and batching them for processing, They could transmit transaction data electronically in near real time. This sped up the time between when a purchase was made and when the merchant received payment, improving cash flow for businesses. It also allowed for better fraud detection, as patterns could be analysed across transactions rather than identified only when reviewing batches of paper slips days later. The settlement systems, the mechanisms for actually moving money between banks to balance out credit card transactions, became increasingly automated. In the early days, settlement required extensive manual reconciliation. Banks would calculate how much they owed to other banks and how much other banks owed to them based on credit card transactions, then settle the net differences. This was complex and error-prone when done by hand. Automated systems using the same computer networks that authorized transactions could settle accounts accurately and efficiently, handling millions of transactions daily. All of this infrastructure was expensive to build and maintain. The networks charged fees to support it, taking small percentages of each transaction. Banks charged merchants to accept credit cards, passing along network fees plus their own margin. Merchants, in turn, built these costs into their prices, effectively making all customers, whether they paid with cards or cash, subsidize the credit card system. There were occasional merchant rebellions against this arrangement. Some retailers refused to accept credit cards, insisting on cash or checks only. Others accepted cards reluctantly, grumbling about the fees but fearing that refusing cards would drive customers to competitors. A few tried to impose surcharges on credit card transactions, charging a higher price when customers paid with cards to offset the merchant fees. The networks generally prohibited this in their merchant agreements, arguing that surcharges would confuse customers and undermine card acceptance. The question of who pays for the credit card system, who bears its costs and who enjoys its benefits, was complicated and would remain so. Cardholders enjoyed convenience and, increasingly, rewards like airline miles or cashback. Merchants gained sales they might not have made if customers had to pay cash. Banks earned interest and fees. The networks facilitated all of this and took their cut. But was the system efficient? Did the benefits exceed the costs? Were the costs fairly distributed? These questions didn't have simple answers, and different stakeholders would answer them differently based on their perspective and interests. By 1980, Visa and Mastercard together processed billions of transactions annually. The infrastructure they'd built, the networks they'd organized, the standards they'd created, all of this constituted one of the most successful examples of cooperative competition in business history. Thousands of banks that competed fiercely for customers cooperated seamlessly on transaction processing. Millions of merchants that competed for sales all accepted the same cards. Hundreds of millions of consumers could use their cards almost anywhere, taking for granted a payment system that worked invisibly and reliably. Hock, reflecting on what Visa had become, would later describe it as an example of how organizations could be structured to enable cooperation without stifling competition, to create order without imposing rigid hierarchy, to serve multiple stakeholders without being captured by any single interest. His Cordic model never became mainstream organizational theory, but Visa itself stood as proof that the model could work at enormous scale. The credit card networks had solved an extraordinary coordination problem. They'd created trust infrastructure that allowed strangers to transact. When you used your Visa card at a store you'd never visited before, in a city you didn't live in, the store trusted that they'd be paid because Visa guaranteed it. Visa trusted that your bank would pay them. Your bank trusted that you'd pay them, or at least that the interest and fees they'd earn would cover their losses on accounts that defaulted. This chain of trust, maintained through contracts and technology and careful risk management, enabled commerce at a scale and speed that would have been impossible in a world where every transaction required personal knowledge and direct trust between buyer and seller. As we move forward into the 1980s and 90s, this infrastructure will support explosive growth in credit card use, growth that will transform American consumer culture, American household finance, and ultimately the global economy. But the foundation, the organizational structure and technical systems and cooperative frameworks, this foundation was built in the 1970s, quietly and methodically, by banks working together through networks they collectively owned and governed. The revolution, as so often happens, was as much institutional and organizational as it was technological or financial. The pieces of plastic in people's wallets were just the visible surface of a vast invisible system, working constantly, processing millions of transactions, moving billions of dollars, enabling the simple everyday act of buying now and paying later. The infrastructure was in place, the networks were organized, and through the early 1980s, credit cards spread through American society with remarkable speed. What had been a product for the middle and upper classes was becoming nearly universal, a financial tool that Americans across income levels were adopting, using, and increasingly depending on. This democratization of credit access brought genuine benefits, real convenience, meaningful financial flexibility for millions of households. But it also brought problems, consequences that regulators and consumer advocates were only beginning to understand. Let's think about what was happening at the household level. In 1980, the typical American household with credit cards had perhaps 2 cards with a combined credit limit of a few $1,000s. By 1990, that same household might have 5 or 6 cards with combined credit limits of $15,000 or $20,000. The amount of credit available had exploded, not because households had become wealthier or more creditworthy, but because banks were competing aggressively for customers, and one way to compete was to offer higher credit limits. From the bank's perspective, this made sense. If you had a good payment history, if you used your card regularly and made at least minimum payments on time, the bank wanted you to use that card more, to carry larger balances, to generate more interest income. Raising your credit limit encouraged this. It also created a psychological effect where higher limits felt like more financial capacity, more room to spend, even though, of course, a credit limit isn't actual wealth, but merely borrowing capacity that comes with costs. Banks also discovered that they could make money not just from interest on carried balances, but from fees. Annual fees had been common early on, but through the 1980s, many banks eliminated annual fees for their basic cards, using no annual fee as a marketing point. But they added other fees: late payment fees, over-limit fees, balance transfer fees, cash advance fees, foreign transaction fees. Each fee was individually small enough not to seem outrageous, but collectively they added up to significant revenue streams. Some banks developed business models that relied heavily on fees, particularly targeting consumers with imperfect credit who might not qualify for the best cards. These subprime credit cards, as they came to be called, often had low credit limits, very high interest rates, and numerous fees. The annual fee might be $50 or $75, charged immediately when you open the account, reducing your available credit from the start. A late payment might trigger a $35 fee plus an interest rate increase. Going even $1 over your credit limit might cost another $35. Consumer advocates criticized these practices as predatory, as exploiting people who were financially vulnerable. The banks defended them as appropriately pricing risk. Lending to people with poor credit history meant higher default rates, they argued, and higher fees and interest rates were necessary to cover losses and still make lending profitable. Without these subprime cards, they claimed, millions of Americans would have no access to credit at all. This debate about whether high-cost credit is better than no credit, about where to draw the line between appropriate risk pricing and predatory lending, would continue for decades. There were legitimate points on both sides. Access to credit, even expensive credit, could help people smooth income fluctuations, handle emergencies, build or rebuild credit history. But expensive credit could also trap people in debt cycles, where they borrowed to handle one crisis only to create future crises through the debt service obligations they'd taken on. Through the 1980s and into the 1990s, household credit card debt grew steadily. In 1980, the average household with credit card debt owed perhaps $800. By 1990, that had grown to around $2,500. By 2000, it would reach nearly $8,000. These are averages, of course, hiding wide variation. Some households paid their balances in full every month, carrying no debt. Others carried balances approaching their credit limits, paying hundreds or thousands of dollars in interest annually. The growth in credit card debt coincided with broader changes in American household finances. Real wages for many workers stagnated through this period, even as the cost of living, particularly for housing, healthcare, and education, rose significantly. Credit cards became a way to maintain living standards despite this income-expense squeeze. If your income wasn't quite covering your expenses, you could bridge the gap with credit cards, at least temporarily. The problem was that temporarily often became permanently, as the debt accumulated and interest charges made it harder to pay down. Bankruptcy rates rose through the 1980s and 90s, not coincidentally. When households took on more debt than they could service, when job loss or medical emergency or simple overextension made it impossible to pay obligations, bankruptcy became the escape route. Credit card debt was usually unsecured, meaning it wasn't backed by collateral the way a mortgage or auto loan was, so it could be discharged in bankruptcy. Banks wrote off billions of dollars in credit card debt through bankruptcy proceedings, losses they factored into their pricing models, but that nonetheless represented failed loans, broken promises on both sides. Congress and regulators watched these trends with growing concern. The Truth in Lending Act of 1968 had required disclosure of credit terms, but disclosure alone wasn't preventing problems. People either didn't read or didn't understand the disclosures. The terms themselves could be complex, with variable interest rates that could change based on factors not always clear to cardholders. The minimum payment structures meant that paying only the minimum could leave you in debt for decades, paying many times the original purchase price in interest. In 1988, Congress passed the Fair Credit and Charge Card Disclosure Act, requiring more prominent disclosure of rates, fees, and grace periods in credit card advertising and applications. The law mandated that when banks solicited you with a credit card offer, the terms had to be presented clearly in a standardized format called the Schumer box, named after Senator Charles Schumer, who championed the legislation. The Schumer box listed the annual percentage rate, annual fees, minimum finance charge, grace period, and balance calculation method in a table format that made comparison across cards easier. This helped, at least for consumers who took the time to read and compare. But many people didn't. They chose cards based on whatever offer arrived in the mail, or whatever their friends recommended, or simply the first card they were approved for. The psychological and behavioral aspects of financial decision-making, the ways people's actual behavior deviated from the rational actor model that economists assumed, were becoming increasingly apparent. Credit card companies understood these behavioral patterns better than regulators or consumers did. They knew that many people focused on minimum payments rather than total debt. They knew that rewards programs, offering airline miles or cashback, could encourage card use even when the rewards value was far less than the interest costs people would pay carrying balances. They knew that convenience features like credit card checks that could be written against your credit line could trigger additional borrowing that might not have happened otherwise. The companies hired behavioral psychologists, studied how people made financial decisions, designed their products and marketing to exploit cognitive biases. This wasn't necessarily evil or even unethical by business standards. Companies are supposed to understand their customers and design products that appeal to them. But it did create an asymmetry where sophisticated financial institutions were competing for the business of consumers with limited financial literacy and numerous behavioral biases. Some of the marketing practices were questionable by any standard. Credit card offers flooded mailboxes, sometimes dozens per year per household. The offers often emphasized the positive low introductory rates or no annual fee, while burying the important details in fine print. A 6.9% introductory rate sounded attractive, but it might apply only for 6 months and only to balance transfers, not purchases, and might revert to 18.9% afterward. Reading the full terms required patience and financial sophistication many people lacked. College students became particular targets starting in the 1980s. Credit card companies set up tables on campus, offering free t-shirts or pizza to students who applied for cards. The pitch was about convenience and building credit history, both legitimate benefits. But college students, typically young and inexperienced with credit, often lacked the income to handle debt responsibly. Stories emerged of students graduating with thousands of dollars in credit card debt on top of student loans, starting their adult lives with financial burdens that would take years to resolve. Some universities banned credit card marketing on campus in response to concerns about student debt. Some credit card companies voluntarily agreed to restrictions, like not issuing cards to students under 21 without a cosigner. But the basic practice continued, grounded in the recognition that customers acquired young often became loyal long-term customers, making the investment in marketing to students worthwhile, even if default rates were somewhat higher in this demographic. The credit scoring system became more sophisticated and influential through this period. FICO scores, introduced in 1989, became the industry standard for assessing creditworthiness. The score, ranging from 300 to 850, was calculated based on payment history, amounts owed, length of credit history, new credit applications, and types of credit used. A higher score meant you were considered lower risk, qualifying you for better interest rates and higher credit limits. A lower score meant higher rates and possibly denial of credit. The FICO score was proprietary. Its exact calculation kept secret to prevent gaming. This opacity frustrated consumers and critics who argued that people should understand how they were being evaluated. Fair Isaac Corporation, which developed FICO, argued that transparency would undermine the score's effectiveness, as different behaviors would emerge specifically to manipulate the score, rather than reflecting actual creditworthiness. Regardless of these debates, FICO scores became enormously influential. Banks used them not just for credit card approvals, but increasingly for other lending decisions. Landlords used them for rental applications. Employers sometimes checked them during hiring. A 3-digit number, derived from your financial behavior but calculated by a proprietary algorithm you couldn't fully see, came to have enormous impact on your financial opportunities and costs. The score also created some perverse incentives. Closing old credit card accounts, even ones you didn't use, could hurt your score by reducing your total available credit and shortening your average account age. Applying for new credit could hurt your score through the inquiry itself. The optimal behavior from a credit score perspective was sometimes different from what seemed financially prudent. You might keep cards you didn't want or need just to maintain your score. Through the 1990s, credit card debt continued its steady climb. Part of this was increased usage for everyday purchases. More merchants accepted cards. More people used them for routine expenses like groceries and gas, not just for special purchases. The card was becoming the default payment method for many Americans, with cash reserved for small transactions or situations where cards weren't accepted. There was also aggressive marketing of balance transfers. Credit card companies would offer low or 0% introductory rates on balances transferred from other cards, encouraging consumers to shift debt around in search of lower interest rates. Some financially sophisticated consumers used this to their advantage, transferring balances repeatedly to avoid interest charges, a practice called rate surfing. But others used it to take on additional debt, viewing the freed-up credit limit on the old card as borrowing capacity, rather than recognizing they'd simply moved their existing debt. The debt counseling industry emerged and grew during this period, helping people who'd gotten into credit card trouble develop repayment plans. Some counseling services were legitimate nonprofits providing real assistance. Others were predatory operations that charged high fees for advice of minimal value or even worsened clients' situations. Congress eventually regulated debt counseling more stringently, but not before many people seeking help had been exploited. Bankruptcy reform became a contentious issue through the 1990s. Credit card companies and other lenders argued that bankruptcy laws were too lenient, allowing people to discharge debts too easily, encouraging irresponsible borrowing. Consumer advocates argued the opposite, that bankruptcy was appropriately a last resort for people facing genuine financial catastrophe, and that making it harder to discharge debt would trap people in permanent financial distress. The Bankruptcy Abuse Prevention and Consumer Protection Act, passed in 2005 after years of debate, made bankruptcy more difficult and expensive to file. It required credit counseling before filing, imposed means testing to determine eligibility for Chapter 7 bankruptcy that discharged debts versus Chapter 13 that required repayment plans, and added various procedural requirements that increased the complexity and cost of the process. Whether this law was good policy depended on your perspective. Lenders celebrated it as necessary reform that would reduce strategic bankruptcies by people who could actually pay their debts. Consumer advocates criticized it as making legitimate financial fresh starts harder to obtain, particularly for people facing medical debt or other hardships beyond their control. What was clear was that the law made credit card companies somewhat more secure in their lending, reducing their losses from bankruptcy discharges. By the late 1990s, credit cards had become deeply embedded in American economic life. The infrastructure was mature, the networks were global. The technology was reliable. Nearly every adult had at least one credit card. Many had several. The total credit card debt in the United States exceeded $500 billion, a staggering amount representing millions of individual decisions to borrow, to spend beyond current means, to access credit that previous generations simply hadn't had available. This represented a transformation in American household finance. The availability of consumer credit had given people flexibility their grandparents hadn't known. It had enabled consumption that drove economic growth. It had smoothed income fluctuations and allowed families to handle emergencies. But it had also created debt burdens, interest costs, financial stress that affected millions of households. The credit card was neither purely beneficial nor purely harmful. It was a tool, powerful and widely available, that could be used well or poorly and that carried consequences either way. The regulatory framework had evolved to provide consumer protections, disclosure requirements, fraud liability limits, dispute resolution rights. These protections were real and valuable, but they couldn't prevent people from taking on more debt than they could handle, from paying interest rates that made debts grow faster than they could pay them down, from falling into patterns of minimum payments and rising balances that could persist for years. As we approach the 2000s, as credit cards continue their evolution into the digital age, the fundamental questions about consumer credit remain unresolved. How much credit is too much? Who should have access to credit and at what cost? How should the benefits and risks be distributed among cardholders, merchants, and card issuers? What responsibilities do lenders have to ensure borrowers can actually afford the credit extended to them? These questions don't have simple answers, involve trade-offs between competing values and interests, and continue to shape policy debates and regulatory actions. The credit card, that small piece of plastic carrying embedded financial power, remains at the center of ongoing conversations about money, debt, responsibility, and the nature of a credit-based economy. As credit cards became ubiquitous in American wallets through the 1980s and 90s, the technology supporting them was also quietly transforming. The changes weren't dramatic in the way that smartphones or the internet would later feel revolutionary. Instead, they accumulated gradually, each innovation building on previous ones, making transactions faster, more secure, more convenient, until the system that existed in 2000 was fundamentally different from what had existed in 1970, even though the basic concept of a card representing access to credit remained unchanged. Let's step back for a moment to the early days, to understand how far the technology evolved. When you used a credit card in 1960 or 1970, the process was entirely mechanical and manual. The merchant would take your card, place it in a device called an imprinter, position a multi-part paper form over the card, and slide a roller across the top. The roller pressed down, creating an impression of your embossed card number and name on the paper form through carbon paper layers. The merchant would write the purchase amount, you'd sign one of the copies, and the merchant would keep the carbon copies for their records. This process had a certain satisfying tactile quality. The sound of the roller moving across the form, the physical act of creating a record. People who worked retail in that era remember the zip-zap sound the imprinter made, the smell of the carbon paper, the constant need to stock the multi-part forms. But it was slow, cumbersome, and created opportunities for error and fraud. At the end of each day, merchants would collect all their credit card slips and prepare them for deposit, similar to how they'd prepare cash and checks. The slips would be sent to the merchant's bank, which would process them, crediting the merchant's account minus the merchant fee. The slips would then move through the banking system until they reached the bank that issued the card to the customer, which would add the charge to that customer's monthly bill. This entire process took days, sometimes more than a week. The time between when you made a purchase and when the charge appeared on your account could be 10 or 14 days. This created what's called float, a gap in time where the money had effectively been spent but hadn't yet been collected. For consumers, this was generally positive, a few extra days before the bill came due. For merchants, it meant delayed payment. For the system as a whole, it created inefficiency and opportunities for problems. Authorization was equally cumbersome. For small purchases, many merchants didn't bother authorizing transactions at all. They'd just check the card against a printed booklet of cancelled card numbers that banks distributed monthly or weekly. These booklets listed cards that had been reported stolen or that belonged to accounts closed for non-payment. If your card wasn't in the booklet, the merchant would accept it, taking the risk that you were over your credit limit or that the card had been cancelled since the booklet was printed. For larger purchases, above some threshold that varied by merchant, authorization was required. The merchant would call a phone number, reach an operator at an authorization center, read off your card number and the purchase amount, and wait while the operator looked up your account in their records. This could take several minutes. The operator would check your credit limit, your current balance, whether there were any holds or restrictions on your account, and then either approve or decline the transaction. They'd give the merchant an authorization code to write on the sales slip as proof that approval had been obtained. This phone authorization system was labor-intensive and slow. Long lines could form at checkout during busy times, particularly in the era before computers made looking up account information quick. The authorization centers employed hundreds of operators sitting at desks, taking calls, flipping through account records, providing approval codes. It was a massive human infrastructure supporting what we'd now think of as a simple task. The magnetic stripe changed everything, though the change took years to fully implement. The magnetic stripe, that dark band on the back of every credit card today, became standard in the 1970s. It was developed through a collaboration between IBM and the banking industry, standardized so that cards from any issuer could be read by any terminal from any manufacturer. The stripe stored information electronically: the card number, expiration date, cardholder name, and some additional data for verification purposes. The advantage of the magnetic stripe was that it could be read by machines. Instead of manually typing in a card number or making a physical impression, a merchant could swipe the card through a reader that would capture the information electronically in a fraction of a second. This was faster, more accurate, and created data in a format that computers could process automatically. But getting magnetic stripe technology deployed took time and money. Every merchant needed new equipment, point-of-sale terminals that could read stripes and communicate with authorization systems. These terminals cost hundreds or thousands of dollars each. Small merchants couldn't justify the expense. Larger retailers invested in them gradually, starting with high-volume locations and expanding over years. Through the late 1970s and 1980s, you'd see both old imprinters and new electronic terminals coexisting in stores, with merchants using whichever was appropriate for the card being presented. The magnetic stripe also enabled electronic authorization that was vastly faster than phone authorization. When you swiped your card, the terminal could automatically dial a computer system, transmit the transaction information through telephone lines, receive approval or decline, and display the result to the merchant, all in seconds rather than minutes. The merchant didn't have to call anyone or wait on hold. The authorization was handled entirely by machines communicating with other machines. This electronic authorization system required enormous back-end infrastructure. The computers receiving authorization requests had to access databases containing account information for millions of cardholders, updated continuously as transactions occurred. They had to check credit limits, identify potentially fraudulent patterns, route requests to the correct issuing banks for accounts the authorization system didn't directly control. They had to do all of this thousands of times per minute with near-perfect reliability, because merchants and customers wouldn't tolerate a payment system that frequently failed. Visa and Mastercard invested heavily in building this infrastructure through the 1970s and 80s. They created networks of computers connected by dedicated telephone lines, housed in data centers, with backup power and redundant systems to prevent outages. They developed software to route transactions, to handle authorization logic, to detect fraud. They hired armies of engineers and technicians to maintain and upgrade the systems as transaction volumes grew. The authorization systems became quite sophisticated in their fraud detection capabilities. They could identify suspicious patterns, multiple transactions in different cities within a short time period, purchases that didn't match a cardholder's normal spending behavior, transactions from merchants with high fraud rates. When suspicious activity was detected, the system might decline the transaction or flag it for manual review. Cardholders whose cards were used in unusual ways might receive calls from their bank's fraud department asking to verify purchases. This automated fraud detection was imperfect. It generated false positives, declining legitimate transactions because they looked suspicious. This was embarrassing and inconvenient when it happened. You'd be at a store, perhaps traveling or making an unusual purchase, and your card would be declined for fraud reasons even though you were the legitimate cardholder making a legitimate purchase. You'd have to call your bank to sort it out, a hassle for everyone involved. But the alternative, not detecting fraud, was worse. The false positives were the price of a system that caught most actual fraud before it caused serious damage. The shift from paper to electronic processing also transformed the settlement process. Instead of physically moving paper slips between banks, transaction data could be transmitted electronically. At the end of each day, banks would exchange files containing all the credit card transactions that needed to be settled. The networks would calculate what each bank owed to other banks and what they were owed, then facilitate the actual movement of money to balance the accounts. This electronic data capture and settlement was faster, cheaper, and more accurate than paper-based systems. Merchants received payment in days rather than weeks. Banks could track transactions in near real time rather than waiting for paper to physically arrive. Errors, which had been common with manual data entry and paper processing, dropped dramatically as automated systems handled the work. Through the 1980s and 90s, the technology continued evolving. Point-of-sale terminals became more sophisticated, with better displays, faster processors, more memory. They could handle multiple card types, print detailed receipts, connect to inventory systems to update stock levels automatically as items were sold. The terminal became not just a payment device, but a central component of retail operations. Dial-up connections, where terminals called authorization systems over regular phone lines for each transaction, gave way to dedicated connections that were always available. This made authorization even faster, reducing transaction time from several seconds to a second or two. The difference sounds minimal, but in a busy store processing hundreds of transactions per day, those seconds added up to significant time savings. The back-end systems also scaled up dramatically. In 1980, the Visa network might process a few million transactions on a busy day. By 2000, it was processing tens of millions of transactions daily, heading toward the hundreds of millions. The computer systems had to scale accordingly, requiring constant upgrades to processing capacity, storage, networking bandwidth. The fact that this scaling happened largely invisibly, without significant service disruptions, represented remarkable engineering achievement. Data became increasingly valuable through this period. Every credit card transaction generated data. What was purchased, where, when, for how much. This data, aggregated and analyzed, revealed patterns about consumer behavior that were valuable for many purposes. Card issuers used it to identify fraud, to make credit decisions, to market additional products. Merchants used it to understand their customers, to optimize inventory, to plan marketing campaigns. The networks used it to improve their systems and services. There were privacy implications to all this data collection that weren't fully appreciated at the time. When you used a credit card, you were creating a record of your purchase, a record that would be stored in databases, potentially indefinitely. Your spending patterns, the places you shopped, the things you bought, all of this became data that could be analyzed, shared, potentially sold. The technology enabled surveillance of consumer behavior at a scale that would have been impossible in a cash-based economy. Some people were concerned about this from early on, worried about who had access to transaction data and how it might be used. But most people either didn't think about it or accepted it as the trade-off for credit card convenience. The benefits, the ease of not carrying cash, the fraud protection, the rewards programs, seemed worth the cost of reduced privacy. Whether this trade-off was wise, whether people understood what they were giving up, remains debated. The reliability of the credit card system became something people depended on, often without realizing it, until something went wrong. When the systems worked, which was almost always, paying with a card was effortless. You swiped, signed, and left. When the systems failed, even briefly, the disruption was immediate and obvious. A network outage, a computer system crash, a telecommunications failure. Any of these could bring credit card processing to a halt, forcing merchants to either turn away customers or revert to manual paper processes that many younger employees had never been trained on. The networks worked hard to prevent outages, investing in redundancy and fault tolerance. They had backup data centers that could take over if primary systems failed. They had redundant network connections so that if one telecommunications line went down, others could handle the traffic. They tested their disaster recovery systems regularly, simulating failures to ensure they could recover quickly. The goal was what's called high availability, typically measuring uptime as a percentage like 99.99%, meaning the system could be down at most a few minutes per year. Achieving this level of reliability required continuous investment and attention. Technology aged and had to be replaced. Software had bugs that had to be fixed. Traffic patterns changed and capacity had to be increased. Security vulnerabilities were discovered and had to be patched. The work of maintaining and improving the infrastructure never stopped, performed by thousands of people whose jobs consisted of keeping invisible systems running smoothly. By the late 1990s, the credit card payment system had become one of the most complex and successful technology platforms in existence. It processed billions of transactions annually across hundreds of countries. It coordinated the activities of thousands of banks, millions of merchants, hundreds of millions of cardholders. It moved trillions of dollars through the global financial system. And it did all of this largely invisibly, with most people having no idea of the complexity underlying the simple act of swiping a card and signing a receipt. The technology also enabled innovations in card features and benefits. The basic revolving credit card could now offer additional services built on top of the payment infrastructure. Extended warranties on purchases, automatically provided for items bought with the card. Travel insurance, covering certain risks when you bought plane tickets with your card. Purchase protection, replacing items that were stolen or damaged shortly after purchase. These benefits were possible because the technology tracked what you bought and when, allowing the card issuer to verify claims and provide services tied to specific transactions. Rewards programs became increasingly sophisticated with better technology. Instead of simple annual rebates based on total spending, programs could offer different reward rates for different categories of purchases. 2% back on groceries, 3% on gas, 1% on everything else. The technology to track and categorize millions of individual purchases, to calculate rewards accurately, to credit them to accounts properly, this required significant computational capability that earlier systems lacked. The geographic reach of the networks expanded through this period as well. A card issued by a bank in the United States could be used in Europe, Asia, Latin America, anywhere merchants accepted Visa or Mastercard. The authorization would route internationally, through telephone networks and later internet connections, crossing borders invisibly in seconds. Currency conversion would happen automatically, with the purchase amount in local currency converted to your home currency at exchange rates set by the networks. This global reach made credit cards essential for international travelers. Instead of carrying travelers' checks or exchanging currency, you could use your card almost anywhere. The card companies marketed this heavily, positioning themselves as enablers of global commerce and travel. American Express in particular emphasized its international acceptance and services for travelers, maintaining a network of travel offices worldwide where cardholders could get assistance. The technology supporting all of this was increasingly taken for granted. People expected cards to work everywhere, instantly, reliably. When they did, no one particularly noticed or appreciated the systems making it possible. When they didn't, when a card was declined or a transaction failed to process, people were frustrated, inconvenienced, sometimes embarrassed. The technology had created expectations that had to be met constantly. Failure was not acceptable because the system had trained people to depend on it absolutely. As we move toward the 2000s and beyond, toward chip cards and contactless payments and mobile wallets, the technology will continue evolving, always building on what came before. The magnetic stripe won't disappear overnight, but will gradually be supplemented and eventually replaced by more secure technologies. The basic architecture of authorization, clearing, and settlement will persist even as the specific technologies implementing these functions change. The invisible infrastructure supporting the simple act of buying now and paying later will grow ever more complex, ever more capable, ever more essential to daily life in a modern economy. But for most people it will remain invisible, noticed only in its absence, appreciated only when it fails. The quiet miracle of a payment system that works reliably billions of times per day will continue being taken for granted, which is perhaps the highest compliment a technology infrastructure can receive. The technology had made credit cards convenient and reliable, but by the 1980s and 90s, credit cards were becoming something more than just payment tools. they were becoming cultural artifacts. Status symbols, markers of identity and aspiration. The piece of plastic in your wallet said something about who you were, or at least who you wanted others to think you were. And the credit card companies, understanding this perfectly, began marketing cards not just as financial products but as lifestyle accessories. Think about how credit cards were portrayed in advertising during this period. The commercials didn't focus primarily on interest rates or credit limits, though these were mentioned. Instead, they showed beautiful people in exotic locations, business travelers in first-class cabins, families making memories at theme parks or beach resorts. The implicit message was that the card enabled these experiences, that having the right card opened doors to a better, more exciting, more sophisticated life. American Express was particularly masterful at this kind of marketing. Their tagline, "Membership has its privileges," positioned the card as exclusive access to a club of discerning, successful people. The card wasn't for everyone, the advertising suggested, which made people want it precisely because it seemed selective. You had to qualify, had to be approved, had to demonstrate that you belonged in this elevated category. Getting an American Express card felt like an achievement, a validation that you'd made it to a certain level of professional or social success. The company reinforced this perception by marketing different tiers of cards with increasing prestige. The basic green card was entry-level, available to most people with decent credit and income. The gold card, introduced in the 1960s but heavily promoted in the 80s, was positioned as premium for people who travelled frequently, who spent significant amounts, who valued superior service and benefits. The Platinum card, launched in 1984, was even more exclusive, available by invitation only initially, with an annual fee of $250 that seemed shocking at the time, but that some people were willing to pay for the status it conferred. And then there was the Centurion card, introduced in 1999, made of titanium and available only to the highest-spending American Express customers. The card had no published annual fee, though reports suggested it was thousands of dollars, was never advertised publicly. You couldn't apply for it. The company would invite you if you spent enough, typically hundreds of thousands of dollars annually, on your other American Express cards. The Centurion card, nicknamed the Black Card for its colour, became legendary as the ultimate status symbol, carried by celebrities and the ultra-wealthy, offering concierge services and privileges that seemed almost absurd in their extravagance. Visa and Mastercard, operating as networks rather than direct card issuers, approached status differently. They created card tiers, classic, gold, platinum, that individual banks could issue, each tier associated with different benefit levels and credit requirements. A platinum Visa from one bank might offer better rewards or services than a platinum Visa from another bank. But the platinum designation itself suggested premium status. The competition in the premium card market was intense through the 1990s and 2000s. Banks vied to offer the most attractive rewards, the best travel benefits, the most impressive perks. Some cards offered access to airport lounges, spaces in terminals where you could wait in comfort, with free food and drinks and quiet seating, away from the chaos of the main concourse. For frequent travellers, lounge access became a valuable benefit, worth the annual fee alone. Other cards offered concierge services, personal assistance available by phone 24 hours a day, to help with travel bookings, restaurant reservations, gift shopping, virtually any task you might want help with. The concierge worked for the card company, not for you personally, but the service created the feeling of having personal staff, of living a lifestyle associated with wealth and luxury, rental car insurance, purchase protection, extended warranties. These practical benefits were marketed alongside the more glamorous perks. The idea was that the card took care of you, protected you, made your life easier and better in multiple ways. You weren't just borrowing money when you used the card. You were accessing a comprehensive suite of services and protections that justified carrying that card rather than a competitor's. The annual fees for premium cards rose steadily. By the 2000s, platinum cards might charge $450 or more annually. Some ultra-premium cards charged thousands. People paid these fees, often willingly, for the combination of benefits and status. The fee itself became a kind of filter, signalling that you were in a category of cardholder willing and able to pay for premium service. For people who travelled frequently for business or pleasure, who stayed in hotels and rented cars and ate at restaurants regularly, The premium cards could provide genuine value. The insurance benefits alone might save hundreds of dollars. The rewards points could fund free flights or hotel stays. The access and convenience were worth something too, harder to quantify but real nonetheless. But for many people, the premium cards were aspirational purchases that didn't make economic sense. They'd pay annual fees for benefits they rarely used, accumulating rewards points they'd never redeem, carrying cards because of what they represented rather than for practical utility. The card companies understood this perfectly and marketed accordingly, selling not just financial products but identity and aspiration. College students became a particularly important demographic during this period. Credit card companies had discovered that customers acquired young often became loyal for decades. Get someone used to using your card in their 20s, and they might still be using it in their 60s. This made marketing to college students, despite their limited current incomes, strategically valuable. The marketing on college campuses was pervasive. Companies set up tables at student centers, offering free t-shirts or frisbees or pizza to students who applied for cards. They sponsored sports teams and campus events. They advertised in student newspapers and on campus radio. The pitch emphasized building credit history, learning financial responsibility, the convenience of not having to ask parents for money. These were legitimate points. Having a credit card and using it responsibly could help young people establish credit history that would benefit them when they later applied for auto loans or mortgages. But college students were also vulnerable to credit card misuse. Many had never managed money independently before. They didn't fully understand interest rates or how carrying balances would affect their finances. They'd use cards for everyday expenses, for spring break trips, for clothing and entertainment, and then be shocked when the bills came due. Some accumulated thousands of dollars in credit card debt before graduating, starting their adult lives already behind financially. There were stories, tragic ones, of students driven to despair by credit card debt they couldn't repay. A few suicides were linked to overwhelming financial pressure from credit cards, though these were rare, and it was impossible to isolate credit card debt from other factors that might have contributed. But they highlighted the darker side of aggressive credit marketing to young people with limited financial experience. Congress eventually responded with restrictions on credit card marketing to people under 21. The Credit Card Accountability, Responsibility and Disclosure Act of 2009, commonly called the CARD Act, required that people under 21 either demonstrate independent income or have a co-signer to get a credit card. Companies couldn't distribute promotional items at college events to induce applications. The law aimed to reduce impulsive credit card acquisition by young people, while still allowing those who could responsibly handle credit to access it. Meanwhile, rewards programs were evolving into increasingly complex and competitive offerings. The first major rewards program had been frequent flyer miles, where credit card spending earned points that could be redeemed for airline tickets. American Airlines partnered with Citibank in 1987 to create the A-Advantage card, and the concept quickly spread. Other airlines partnered with other banks. Soon there were hotel rewards cards, car rental rewards cards, cards offering points redeemable across multiple travel partners. Cashback programs offered simpler rewards, a percentage of your spending returned to you as statement credits or checks. These were less exciting than travel rewards, but more flexible and easier to understand. You spent $1,000, you got $10 or $20 or $30 back depending on the card's cashback rate. No complicated redemption schemes, no blackout dates, just money. The economics of rewards programs were interesting and not always obvious. The rewards were funded primarily through merchant fees and interest charges. When you used your card, the merchant paid a fee to the card issuer and network, typically 2 to 3% of the transaction amount. Some of this fee went to fund rewards. Additionally, people who carried balances paid interest, and some of this interest subsidized rewards for people who paid in full monthly. This created a somewhat regressive transfer, where less affluent cardholders who carried balances and paid interest were effectively subsidizing rewards for more affluent cardholders who paid in full and maximized rewards. The people best able to manage credit responsibly got the benefits. Those struggling with debt paid for those benefits through interest charges. Some economists and consumer advocates argued this was unfair, a hidden cost of the reward system that went largely unrecognized. But rewards programs were popular with consumers and effective for card issuers in encouraging card usage and building loyalty. People would choose where to shop based on which purchases earned the most rewards. They'd carry multiple cards, using whichever offered the best rewards for a particular category of spending. A whole subculture emerged of rewards optimizers, people who studied credit card programs obsessively, developed strategies to maximize points earning, and redeemed rewards for outsized value through clever use of partner programs and transfer opportunities. For the average person, rewards programs offered modest but real benefits. A few $100s a year in cashback or a free flight occasionally made the card feel more valuable. The psychological impact was significant too. Getting rewards felt like winning, like the card was paying you to use it, even though the rewards were funded through fees and interest that raised overall prices for everyone. Through the late 1990s and 2000s, credit cards also became normalized for everyday small purchases. Earlier, cards had been used primarily for larger transactions, things like airline tickets, hotel stays, significant retail purchases. You'd pay cash for coffee, for lunch, for groceries. But as cards became more widely accepted and payment processing became faster, people began using them for everything, even purchases of a few dollars. This shift was encouraged by card companies, which made money on every transaction regardless of size. Merchants were less enthusiastic, particularly for very small purchases where the merchant fee as a percentage of the transaction was high. A 2% fee on a $100 purchase was $2, reasonable. A 2% fee on a $3 coffee was 6 cents, which sounds small but represented a larger percentage of the merchant's profit margin on that coffee. Some merchants tried to impose minimum purchase amounts for credit card use, requiring that you spend at least $5 or $10 to pay with a card. The card networks generally prohibited this in their merchant agreements, arguing that merchants should accept cards for all transactions to ensure customer convenience. The networks eventually relaxed this rule under legal and regulatory pressure, allowing merchants to set minimums up to $10. The normalization of cards for small purchases had psychological effects. When people paid cash for small purchases, they felt the accumulation, the wallet getting lighter, the visible depletion of resources. When they paid with cards, small purchases felt costless, at least until the bill arrived. This probably encouraged more frequent small purchases, more impulse buying, more consumption than would have happened in a cash-only economy. Credit card debt as a percentage of household income grew through this period. By the mid-2000s, the average American household with credit card debt owed close to $8,000, paying perhaps $1,200 to $1,500 in interest annually at typical interest rates of 18 to 20%. These averages concealed wide variation. Some households carried minimal debt or none. Others carried balances approaching their credit limits, paying thousands in interest each year, trapped in cycles where they could barely make more than minimum payments. The minimum payment structure of credit cards made these debt cycles persistent. Credit card companies typically set minimum payments at around 2 to 3% of the balance, or a small fixed amount like $15 or $20, whichever was greater. If you owed $5,000 at 18% interest and made only the minimum payment of $100 monthly, you'd pay for decades and pay thousands in interest, far more than the original amount borrowed. Most people didn't do this math, didn't realize how long minimum payments would keep them in debt. Card companies were required to disclose it on statements, showing how long payoff would take making only minimum payments, but this disclosure often went unread or unheeded. The behavioral tendency was to focus on the immediate minimum payment amount, which seemed manageable, rather than on the total long-term cost of carrying the debt. Some people use balance transfer strategically to manage debt, moving balances to cards offering 0% or low promotional rates, paying down principal while avoiding interest charges. This could be effective debt management for disciplined people, but it could also enable denial, moving debt around rather than addressing the underlying issue of spending beyond means. The credit card had become deeply woven into American consumer culture by the 2000s. It was how people bought things, how they managed cash flow, how they smoothed irregular income and expenses, how they funded desires that exceeded current resources. For some, it was a useful tool used responsibly. For others, it was a trap, a source of stress and financial hardship. For most, it was probably both at different times, a powerful financial instrument that could be used well or poorly depending on circumstances and choices. The cultural penetration of credit cards was so complete that not having one became unusual, even suspicious. Rental car companies required credit cards, not debit cards, for deposits. Hotels did too. Some employers checked credit reports during hiring, interpreting poor credit as a risk factor. Not having a credit history, which meant not having credit cards or loans, could hurt you in ways that seemed unfair to people who avoided debt on principle. This created pressure to participate in the credit system, even if you'd prefer not to. You might need a credit card just to navigate modern commerce, even if you paid it in full monthly and never carried a balance. The card became less optional, more obligatory, a requirement of economic participation in contemporary society. As we move forward into the 2000s and toward the present, credit cards will continue evolving, adapting to new technologies and new consumer expectations. But the fundamental patterns established by this point, the use of cards for everyday purchases, the rewards programs and premium tiers, the normalization of consumer credit, the psychological and behavioral dimensions of buy now pay later, these patterns will persist. The credit card has become not just a payment method, but a feature of modern economic life, shaping how people think about and relate to money in ways both obvious and subtle, both beneficial and problematic, both liberating and constraining. The credit card that had become so familiar in the United States through the 1980s and 90s was simultaneously spreading across the globe, adapting to different cultures, different regulatory environments, different economic conditions. The story of how credit cards became a worldwide phenomenon reveals how financial innovations cross borders, how they are modified to fit local contexts, and how technology can create systems that span the entire planet while still respecting regional differences. Let's think about what was required for credit cards to work internationally. The most obvious challenge was currency. A card issued by an American bank in dollars needed to work at a merchant in France accepting euros, or in Japan accepting yen, or in Brazil accepting reais. This meant that somewhere in the transaction process, currency conversion had to happen automatically, accurately, at exchange rates that change constantly throughout each day. The card networks solved this by building currency conversion into their processing systems. When you used your card in a foreign country, the transaction would be recorded in the local currency. The merchant's bank would receive payment in local currency, but your bank would bill you in your home currency, using an exchange rate set by the network for that particular day. The networks published daily exchange rates for dozens of currencies, rates that tracked global foreign exchange markets, but included a small markup that represented part of the network's revenue. This currency conversion was invisible to most cardholders and merchants. You'd make a purchase in Paris, paying what appeared to be a simple transaction, and only when your statement arrived would you see the amount converted to dollars. The conversion happened automatically in the back-end systems, requiring no action or even awareness from anyone involved in the transaction. It was a small miracle of coordination that people took entirely for granted. The networks also had to establish relationships with banks in each country where they wanted cards to be accepted. In some countries, this was straightforward. Banks were eager to join Visa or Mastercard networks, to offer their customers international payment capability, to participate in what was clearly becoming the global standard for electronic payments. In other countries, regulatory barriers, national pride, or existing payment systems made entry more difficult. Japan, for instance, had its own domestic credit card system, JCB, which stood for Japan Credit Bureau. JCB cards worked throughout Japan and were accepted by Japanese merchants. The company and the Japanese government were initially reluctant to allow foreign networks to dominate their domestic market. But international pressure, the desire of Japanese citizens to use cards when traveling abroad, and the need for foreign tourists visiting Japan to be able to pay with their cards, all created incentives for JCB to establish reciprocal agreements with Visa and Mastercard. Eventually, most Japanese merchants accepted international cards alongside JCB, and JCB cards gained some acceptance internationally, though never approaching the global reach of Visa or Mastercard. China presented different challenges. The Chinese government tightly controlled financial services and wanted to maintain a domestic payment system under national control. China UnionPay was created in 2002 as the country's domestic card network. For years, foreign cards had limited acceptance in China, and Chinese cards didn't work abroad. But as China's economy grew, as Chinese citizens traveled internationally in increasing numbers, and as foreign tourists and business people needed to pay in China, pressure mounted to allow international card acceptance. Gradually, cautiously, China opened its market to Visa and Mastercard, while ensuring Union Pay remained dominant domestically. Europe had its own complex landscape. Each country initially had national payment systems. The creation of the European Union and the euro created pressure to harmonize payment systems, to make it as easy to use a card in France as in Germany or Italy. The card networks benefited from this harmonization, which reduced the complexity of operating across multiple European countries. But European regulators were also concerned about the power of American-based networks and worked to create competitive alternatives and impose regulatory constraints. The Single Euro Payments Area, known as SEPA, established common standards for euro-denominated payments across Europe. This made domestic European payments easier but didn't directly address credit cards, which continued to operate primarily through Visa and Mastercard, even for intra-European transactions. European authorities periodically investigated these networks for anti-competitive practices, particularly around interchange fees, which European regulators thought were too high. In developing countries, credit card adoption followed different patterns than in wealthy nations. In places where many people lacked bank accounts, where cash was dominant, where income levels made qualifying for credit difficult, traditional credit cards gained limited traction. But mobile payments and prepaid cards sometimes succeeded where credit cards struggled, offering electronic payment capability without requiring credit approval or traditional banking relationships. India, with its enormous population and rapidly growing middle class, became a major market for cards through the 2000s. The government promoted financial inclusion, encouraging banks to serve lower-income customers. Credit cards remained products for the relatively affluent, but debit cards, which drew on money already in bank accounts rather than extending credit, spread widely. International cards worked in India, but domestic networks like RuPay, created by the Indian government, were promoted as national alternatives that kept transaction processing fees in India rather than flowing to foreign networks. Latin America saw significant credit card growth, particularly in Brazil, Mexico, and Argentina. But high interest rates, economic instability, and inflation made credit cards work differently than in stable, wealthy economies. Interest rates on carried balances could exceed 100% annually in some countries during high inflation periods. Cards were used extensively, but more as convenient payment methods with full monthly payment than as credit extension tools. The risk of carrying balances at such high rates was too great for most people. Africa had perhaps the most diverse payment landscape, with some countries having relatively developed banking systems where credit cards functioned normally, and others where mobile money systems like M-Pesa in Kenya became the dominant electronic payment method, largely bypassing traditional cards. The infrastructure required for card payments, point-of-sale terminals connected to reliable telecommunications networks, simply didn't exist in many African communities. Mobile payments working over basic cell phone networks proved more adaptable to African conditions. The Middle East, particularly the wealthy Gulf states, embraced credit cards enthusiastically. High per capita incomes, large expatriate populations accustomed to cards from their home countries, and economies oriented around international business and tourism all supported card adoption. But Islamic finance principles, which prohibit charging or paying interest, created complications. Some banks offered Islamic credit cards that complied with Sharia law through alternative structures, charging fixed fees rather than interest, or using profit-sharing arrangements instead of interest-based lending. Through all these variations, certain patterns emerged. Wealthy, stable countries with developed banking systems saw the highest credit card penetration. Countries with large middle classes, consumer cultures, retail sectors that supported electronic payments, these conditions fostered card usage. Places lacking these characteristics might have cards available, but they remained niche products for elites rather than mass-market financial tools. Security became an increasing concern as cards spread globally. Fraud techniques that worked in one country could be exported to others. International fraud rings would steal card information in one country and use it for purchases in another, making investigation and prosecution difficult. The networks invested in global fraud detection systems that could identify suspicious patterns across borders, declining transactions that matched known fraud indicators, regardless of where they originated. One major security innovation that spread globally, though slowly and unevenly, was the EMV chip. EMV, standing for Europay Mastercard Visa, the three companies that developed the standard, involved embedding a small computer chip in credit cards. The chip stored information more securely than magnetic stripes and could perform cryptographic operations that made counterfeiting much more difficult. Europe adopted chip cards widely in the late 1990s and early 2000s. The magnetic stripe remained on cards for backward compatibility, but chip transactions became standard at European merchants. The chip significantly reduced counterfeit fraud in countries where they were deployed. Criminals could no longer simply copy the magnetic stripe from a legitimate card and create fake cards. The chip-based authentication required the actual chip, which was difficult to duplicate. The United States resisted chip adoption for years, remaining on magnetic stripe technology long after Europe had moved to chips. The reason was largely economic. Replacing every card in circulation with chip cards cost money. Replacing or upgrading every point-of-sale terminal to read chips cost more money. American banks and merchants, looking at fraud rates and weighing costs against benefits, concluded the investment wasn't justified. Fraud was lower in the US than in some other regions. Magnetic stripe technology still worked, and the expense of transitioning to chips seemed unnecessary. But this created problems for international travelers. Americans traveling to Europe found their magnetic stripe cards increasingly difficult to use, as European merchants had chip-reading terminals that sometimes didn't accept magnetic stripe transactions, or that did so reluctantly with additional verification steps. European travelers to America had chip cards that worked, but only through the magnetic stripe, not using the more secure chip. The global payment system, despite its sophistication, had fragmented into different technological standards in different regions. Eventually, a series of major data breaches in the United States, where criminals stole information for millions of credit cards, created pressure for better security. The liability shift that occurred in October 2015 made merchants responsible for fraud on chip-capable cards if the merchant didn't have chip-reading terminals, providing strong incentive to upgrade equipment. By the late 2010s, chip cards and chip-reading terminals became standard in America, finally aligning with global standards. The chip transition illustrates how global payment networks navigate between standardization and local variation. The networks wanted global standards that made cards work the same everywhere, reducing complexity and cost. But different regions had different priorities, different economic conditions, different regulatory requirements. The networks had to accommodate these differences while still maintaining interoperability, ensuring that a card issued anywhere could ultimately be used anywhere, even if the specific technology and processes varied by location. Foreign transaction fees became a common and often surprising charge for international card use. When you used your card abroad, your card issuer typically charged a foreign transaction fee, usually around 3% of the purchase amount. This fee was separate from the currency conversion, additional revenue for the card issuer. Many cardholders didn't realize this fee existed until they reviewed their statements and saw charges higher than expected. Some premium cards waived foreign transaction fees as a benefit, particularly cards marketed to frequent travelers. This made those cards more attractive for international use despite higher annual fees. For people who traveled often, a card with no foreign transaction fees could save hundreds of dollars annually compared to cards that charged these fees. The global expansion of credit card networks created network effects on a planetary scale. The more countries where cards were accepted, the more valuable the cards became to holders. The more cardholders existed globally, the more attractive it became for merchants anywhere to accept cards. This created momentum toward universal acceptance, toward a world where you could use the same card in Tokyo, Paris, Nairobi, and Sao Paulo without thinking about it, where electronic payments worked across all borders and currencies. But this universalization also raised questions about power and control. American companies, Visa and Mastercard, dominated global payment infrastructure. Transactions between a German cardholder and a French merchant, denominated in euros, still likely flowed through computer systems in the United States, subject to American regulations and potentially American surveillance. Some countries found this uncomfortable, raising concerns about sovereignty, privacy, and dependency on American financial infrastructure. These concerns led to various national and regional initiatives to create alternatives. China's Union Pay, Europe's various domestic systems, Russia's Mir card after sanctions limited access to Visa and Mastercard, India's RuPay. These all represented attempts to maintain some independence from American-dominated networks, but none achieved the global reach of Visa or Mastercard, which benefited from decades of network building, enormous investment in technology and relationships, and first-mover advantages that made competing at global scale extraordinarily difficult. The question of data sovereignty also emerged. When credit card transaction data flowed through American systems, American government and intelligence agencies potentially had access to information about purchase patterns worldwide. This might seem paranoid, but revelations about surveillance programs suggested such access was real. For individuals, this might not matter much. For governments and corporations worried about economic espionage or privacy, it was a legitimate concern. The globalization of credit cards also meant that financial crises and problems could spread more easily. When the 2008 financial crisis hit, affecting credit availability and household finances worldwide, credit card defaults rose not just in America, but globally. The interconnection of financial systems, facilitated partly by global payment networks, meant that economic shocks propagated rapidly across borders. Despite these concerns and complications, the global spread of credit cards through the late 20th and early 21st centuries represented remarkable achievement in international coordination. Creating systems that worked reliably across borders, currencies, languages, and regulatory environments required cooperation among thousands of institutions. The fact that it worked, that you could use a card almost anywhere on Earth and trust that the transaction would process correctly, represented extraordinary organizational and technical accomplishment. As we move toward thinking about the digital future of payments, toward mobile wallets and cryptocurrency and other innovations, it's worth appreciating what the global credit card networks built. They created the first truly worldwide electronic payment system, infrastructure that billions of people now depend on, that processes trillions of dollars in commerce annually, that has become essential to how the global economy functions. The little piece of plastic in your wallet connects you to a system spanning the entire planet, operating continuously, invisibly enabling the simple act of buying something wherever you happen to be. That system, built gradually over decades through technical innovation and institutional cooperation, represents one of the quiet marvels of modern economic life. The global infrastructure supporting credit cards had become vast and complex by the 2000s, a system operating largely invisibly. Noticed only when it failed. Let's slow down for a moment and really think about what happens in the few seconds between when you hand your credit card to a merchant and when the transaction is approved. Because understanding this journey, this cascade of electronic messages and database queries and risk calculations, reveals something remarkable about the hidden machinery of modern commerce. You're standing at a checkout counter. You hand your card to the clerk, or perhaps you insert it into a terminal yourself. The moment the card is read, whether by swiping the magnetic stripe or inserting the chip, information begins to flow. The card number, expiration date, and a verification code are captured electronically. If it's a chip transaction, the chip performs a cryptographic operation, creating a unique code for this specific transaction that can't be reused, protecting against certain types of fraud. This information travels from the terminal through the merchant's payment processor, a company that handles payment processing on behalf of merchants. The processor routes the transaction to the appropriate card network, Visa or Mastercard or American Express or Discover, based on the card number. The networks maintain computer systems that process authorization requests constantly, every second of every day, handling tens of thousands of requests simultaneously. When your transaction reaches the network's computers, those systems route it to your card issuer, the bank that gave you the card and extends you credit. This routing happens in milliseconds, identifying which of thousands of potential issuing banks holds your account, finding the correct computer system at that bank, and sending the authorization request there. At your issuing bank, computer systems check multiple things almost instantaneously. Is the card active and valid, not reported lost or stolen, not expired, not cancelled? Does the purchase amount fit within your available credit limit? Have you made your required payments? or are you in default? Does this transaction match your normal spending patterns, or does it look suspicious, potentially fraudulent? The fraud detection algorithms are sophisticated, comparing each transaction against historical patterns. If you typically make purchases in California and suddenly there's a transaction from New York, the system notices. If you normally spend $30 to $50 at restaurants and suddenly there's a $900 restaurant charge, the system flags it. If there are multiple transactions in quick succession from different merchants, potentially indicating a stolen card being used rapidly before being reported, the system identifies this pattern. These fraud checks happen in fractions of a second. Algorithms processing vast amounts of data, calculating probabilities, making decisions. Most transactions pass all checks and are approved. Some trigger additional verification, perhaps requiring the merchant to ask for identification or contact the bank for manual approval. A small percentage are declined, either because they exceed credit limits or because fraud systems identify them as too risky. The authorization response travels back through the network to the merchant's terminal, usually within 2 to 3 seconds of the initial card read. The terminal displays the result, approved or declined. If approved, the merchant completes the sale, giving you a receipt. If declined, well, you have to find another way to pay, an awkward moment that's hopefully rare. But the transaction isn't actually complete yet. What just happened was authorization, confirmation that the card is valid and the charge is within limits. The actual movement of money, the settlement, happens later, typically at the end of the business day when merchants submit batches of approved transactions for payment. During settlement, transaction information flows through the networks again, this time not for authorization, but for payment. The networks calculate what each merchant's bank is owed for transactions made by cards issued by other banks. They calculate what each issuing bank owes for their cardholders' purchases at merchants banked elsewhere. These amounts are netted out, determining the actual money that needs to move between banks to balance all the day's transactions. The actual fund transfers happen through banking settlement systems, moving money between banks' accounts at central banks or through correspondent banking relationships. The merchant's bank credits the merchant's account minus the merchant discount fee, usually within a few days. The cardholder's bank adds the charge to the cardholder's account, eventually billing them in their monthly statement. This entire process, from authorization through settlement to billing, involves multiple parties: the cardholder, the merchant's bank, the card network, the issuing bank, and various intermediaries like payment processors and settlement systems. Each party has a role, each takes a small cut of the transaction value, each adds some piece of the infrastructure or service that makes the system work. The scale at which this operates is staggering. Visa's network, called VisaNet, can handle more than 65,000 transaction messages per second at peak capacity. On a typical day, it processes several billion transactions globally. Mastercard operates at similar scale. These systems run continuously, 24 hours a day, 7 days a week, processing payments for purchases large and small, from cups of coffee to luxury automobiles, in virtually every country on Earth. The reliability required is extraordinary. A payment network can't have significant downtime. Commerce depends on it working. When systems fail, even briefly, the impact is immediate and visible. Merchants can't process payments, customers can't complete purchases. The backlog of transactions accumulates rapidly, taking hours to clear even after systems are restored. This is why the networks invest so heavily in redundancy, backup systems, disaster recovery capabilities. The data centers processing these transactions are housed in secure facilities with multiple layers of protection. Physical security prevents unauthorized access. The buildings are nondescript, not marked with company logos, located in areas where they don't attract attention. Inside, the security resembles what you'd see at military installations: guards, access controls, surveillance, procedures for verifying identity and authorization. The computer systems themselves are redundant. Critical systems exist in multiple data centers in different geographic locations. If one data center experiences problems, another can take over the processing load seamlessly. The data is continuously backed up, synchronized across facilities, so that no single failure point can bring down the network or lose transaction records. The telecommunications networks connecting all these systems are similarly redundant. Transactions flow over multiple carriers, multiple routes, with automatic failover if one path becomes unavailable. The networks maintain private connections between major nodes, not relying entirely on public internet, ensuring they control the infrastructure their data travels through. Despite all these precautions, failures occasionally happen. A software bug might cause incorrect transaction processing. A telecommunications outage might prevent authorization requests from reaching issuing banks. A cyber attack might overwhelm systems with fraudulent traffic. When failures occur, they're typically brief, minutes or occasionally hours, but they expose how dependent modern commerce has become on these invisible systems. The human labor supporting these systems is less visible than the technology, but equally essential. Thousands of people work maintaining the computer systems, monitoring network performance, responding to outages, developing new features, managing security. Customer service representatives handle calls from cardholders with questions about charges or from merchants with problems processing transactions. Fraud analysts investigate suspicious patterns, contact customers to verify unusual transactions, make decisions about whether to approve or block charges. The work happens around the clock because the payment networks are global, operating across all time zones. When it's midnight in New York, it's midday in Tokyo, and transactions are being processed from everywhere simultaneously. The operations centers monitoring these systems are staffed continuously, teams working in shifts, watching dashboards displaying system status, ready to respond to any problems that arise. The fraud detection teams are particularly interesting. They review transactions flagged by automated systems as potentially fraudulent, making judgment calls about whether charges are legitimate. This requires understanding normal patterns and recognizing deviations. A large purchase at an electronics store might be normal for someone who regularly buys expensive electronics, but suspicious for someone whose typical purchases are groceries and gas. The analysts review histories, consider contexts, sometimes contact cardholders directly to ask, "Did you make this purchase?" The sophistication of fraud detection has increased dramatically with machine learning algorithms that can identify patterns humans might miss. The systems learn from previous fraud cases, recognizing combinations of factors that indicate risk, even when no single factor is definitive. They adapt as fraud techniques evolve, as criminals find new ways to exploit the system. But automated fraud detection isn't perfect. It generates false positives, declining legitimate transactions, which frustrates cardholders and merchants. It can also reflect biases in the data it's trained on, potentially discriminating against certain groups of people whose normal spending patterns happen to match fraud indicators. The networks work to reduce these problems, but tensions between security and convenience, between protecting against fraud and serving legitimate customers, remain constant. The card networks also maintain rules and standards that participating banks and merchants must follow. These rules cover everything from how cards should be manufactured and embossed, to how merchants should verify signatures to what fees can be charged in various circumstances. The rules are detailed, running to hundreds of pages, and are updated regularly as technology, fraud techniques, and business practices evolve. Enforcing these rules requires monitoring and occasionally penalizing participants who don't comply. If a bank issues cards that don't meet security standards, exposing the network to fraud risk, the network can impose fines or even revoke the bank's participation. If a merchant has excessive fraud or chargebacks, indicating poor verification practices or potentially collusion with fraud, the merchant can lose the ability to accept cards. The chargeback process, where cardholders dispute charges they claim are unauthorized or unsatisfactory, involves extensive infrastructure and rules. When you dispute a charge, your bank investigates, potentially reversing the charge and returning money to your account. The merchant's bank then investigates from the merchant's side. If the dispute isn't resolved, it escalates through various levels of review, with the network sometimes serving as arbitrators, making final decisions based on documentation and established rules. Chargebacks protect cardholders but create costs and risks for merchants. A merchant who loses a chargeback dispute not only loses the sale, but also typically pays a fee. High chargeback rates can lead to higher processing fees or loss of card acceptance entirely. This creates incentive for merchants to verify customers and maintain good records. but it also means merchants sometimes lose disputes over legitimate sales when cardholders falsely claim fraud or dissatisfaction. The systems tracking all of this, every transaction, every authorization, every settlement, every dispute, generate enormous amounts of data. This data is valuable for many purposes beyond just processing payments. Card issuers analyze it to understand customer behavior, to identify which customers are profitable, to make credit limit decisions, to market additional products. Merchants analyze it to understand sales patterns, inventory needs, customer preferences. The networks themselves analyze transaction data at aggregate levels, identifying trends in consumer spending, tracking seasonal patterns, monitoring economic indicators. This data has become valuable for economic research and forecasting, providing real-time insights into consumer behavior that traditional economic statistics, published weeks or months after the fact, can't match. But the accumulation of detailed purchase data raises significant privacy concerns. Your credit card transactions create a comprehensive record of where you go, what you buy, when you shop, how you spend your time and money. This record exists in databases controlled by your card issuer and the payment networks, potentially accessible to government agencies through legal process, potentially vulnerable to hacking or unauthorized access. Most people don't think about this surveillance dimension of credit card use. The convenience is immediate and obvious. The privacy cost is abstract and invisible. You get your coffee quickly without fumbling for cash. Somewhere a database notes that you bought coffee at this location at this time for this amount, adding another data point to your transaction history, a history that will persist for years, outlasting your memory of the purchase itself. The infrastructure supporting all of this, the computers and networks and buildings and people, represents investment of tens of billions of dollars over decades. The ongoing operational costs, electricity to run data centers, telecommunications costs, salaries for thousands of employees, run into billions annually. These costs are covered by the fees charged to merchants and cardholders, by interest on carried balances, by the small percentages taken from each transaction as it flows through the system. Whether these costs are justified, whether the value created exceeds the resources consumed, depends on your perspective. For individuals, the convenience is real and valued. For merchants, card acceptance is necessary to compete, even if the fees reduce profit margins. For the broader economy, electronic payments are more efficient than cash in many ways, reducing transaction costs, enabling commerce that might not otherwise happen, creating data that helps optimize business operations. But there are alternatives. Cash still exists, still works, still provides privacy and certainty that electronic payments can't match. In some countries, mobile payment systems have emerged that route around traditional card networks, potentially offering lower costs or better features. Cryptocurrency enthusiasts envision payment systems that don't require centralized intermediaries at all, though these visions have yet to achieve the scale, reliability, or user-friendliness of existing card networks. The credit card infrastructure, for all its complexity and cost, has achieved something remarkable. It has made electronic payment boring, routine, utterly reliable for billions of people worldwide. You can use your card without thinking about the technology, without understanding the processes, without worrying whether it will work. It just works, almost always, everywhere you go. That mundane reliability, that invisible competence, represents one of the great engineering and organizational achievements of the late 20th and early 21st centuries. As we think about the future, about digital wallets and biometric authentication and blockchain and whatever payment innovations are coming, it's worth appreciating what exists now, the infrastructure that quietly supports modern commerce, that processes your purchase in seconds while you barely notice. The journey of your credit card transaction, from terminal to authorization to settlement to billing, touches systems across the globe, involves institutions you've never heard of, employs people you'll never meet, all working together seamlessly to enable the simple, everyday act of buying what you need or want and paying for it later. And so, we've travelled together through the quiet revolution of a small piece of plastic, from a forgotten wallet at a Manhattan restaurant, whether that story was true or invented, to a global system processing billions of transactions every day. We've watched as trust became portable, as buying now and paying later transformed from personal relationship to invisible infrastructure, as technology and human ingenuity built systems that span the entire world. What strikes me most, looking back across this journey, isn't the technology or the networks or even the vast sums of money flowing through the system. It's how ordinary it all became, how something revolutionary, something that would have seemed like magic to someone living just a century ago, turned into something so mundane we barely notice it. The credit card in your wallet connects you to systems touching every corner of Earth, yet you use it without thought, without wonder, taking for granted the extraordinary coordination that makes each transaction possible. There's something deeply human in this story, the desire for convenience, for flexibility, for not being constrained by the cash in our pockets right now. The building of trust across distance, across borders, across cultures, the slow accumulation of small innovations into transformation, the quiet work of thousands of people maintaining systems most of us never see or think about. If you've enjoyed this gentle exploration of how credit cards changed our world, a like and subscribe helps others find these peaceful journeys through financial history. And to all of you already here, already part of this thoughtful community, thank you. Your presence makes this possible. Wherever you are right now, whatever time it is in your corner of the world, I hope you're comfortable. I hope the weight of your day has lifted somewhat. The story of credit cards, of buy now, pay later, is also a story about human adaptability, about how we create tools and systems to serve our needs, about how innovation happens quietly, incrementally, until one day we look around and everything has changed. Let your breathing slow, let your thoughts drift. The infrastructure we've explored tonight, those computer systems processing transactions, those networks spanning continents, they're all still running right now, working invisibly while you rest. Millions of small moments of commerce happening in the darkness, people buying what they need, the systems quietly enabling it all. You don't need to remember the details. You don't need to hold on to the facts and figures. What matters is the sense of wonder at how much complexity can hide behind something simple, how much human effort supports our everyday conveniences, how the world we take for granted was built slowly, carefully, by people solving problems and creating trust. Rest now. Let it all go. The credit cards will keep working while you sleep. The systems will keep running. The quiet revolution continues, patient and persistent, needing nothing from you right now except perhaps a moment of appreciation for how far we've come, how much we've built together, how the small piece of plastic in your wallet represents decades of innovation, coordination, and human ingenuity working toward making life just a little bit easier. Sleep well, dream gently. Good night.